they have been outlining these struggles in a great way. They are working on a broader model lineup that will be hopefully turning things around for them. And what has been clear from what they told us last night is they are seeing signs of coming through the trough by adding more models that are improving their bottom line.
Okay, Elizabeth, thank you very much. Thanks for the update. Elizabeth Behrman, Bloomberg EMEA Automotive's team leader. And it is the automotive sector that stands out to the downside, or has been doing for much of this morning, but also the media sector. So autos and parts is one of the worst performing sectors this morning. Universal Music Group, though, is down by 6.3%, and that's weighing on the media sector today. So but not much is looking pretty this morning, is it, to the upside for European stocks, apart from energy?
Air France is actually having a fairly good morning. I thought that Air France would be battered by the news on what it's seeing in terms of the cost picture relating to fuel, but actually stock looks okay. So there are a few bright spots out there. Yes, you do wonder whether the ECB could make things worse a little bit later on. If it turns out to be quite a negative picture coming through from the ECB, if Christine Lagarde sort of paints a growth concern story, what happens there?
Yeah.
She talks about
raising rates. Is that the worst thing, or is it worse to talk about raising rates?
Yeah.
In terms of risk appetite, I'm not sure which looks better or worse.
We're like nil point for French growth coming through today.
Yeah.
Spain's looking a little bit more robust. Interesting on the tech front, you're not getting a read across. So $275 billion is the new capex commitments for the big hyperscalers. ST Micro is up a bit. ASML is up just 0.3%. So not seeing a big read across, but again, the macro environment today may be the bigger drag there.
Yes, and on the macro environment, we'll talk about the ECB and the Bank of England, both expected to keep rates on hold later today. But what kind of narrative will we get along with those rate conversations? This is Bloomberg.
Hello there. Just wanted to say, Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in Season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch Season 2 on all these lovely channels.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Anand, only on Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
This is the opening trade. We are 30 minutes into today's sessions. The futures picture had looked far worse than what we're seeing right now. So we've paired some of the losses, but nonetheless, you are down 0.3%. And across different sectors and different companies, you're seeing some pretty sizable moves. So across the benchmark, you're seeing losses of 0.3%. Concerns, obviously, around the oil story and energy up once again, above $120 per barrel on Brent. DAX is currently down 0.3%. The auto sector is under pressure. Energy and tech are in positive territory, so you're seeing a bit of a lift for the FTSE 100, bit of support there, up 0.1%. When it comes to the CAC count on France, the worst performer across these indexes, at least down a full 1%, dropping 87 points so far. Guy, what are you seeing?
I'm seeing a market that's reasonably balanced, actually. As you say, slight bias towards the downside in terms of the performance we're seeing. So you've got 366 stocks down, 215 up. Volume's actually reasonably good today. It's an average, so at some point you need to get a more positive picture maybe emerging. But it has been weak of late, so it's interesting on such a big day you are seeing quite a lot of activity through the market, or a raised level of activity going through the market. Let's talk about some of the leaders and laggards that we are seeing. Unsurprisingly, with oil prices, what they are doing this morning, you are seeing names like Shell rising. So Shell is up by 0.7%. Rolls-Royce on a two-day basis is still negative, but after the numbers this morning, it is positive on today. So you just need to kind of look at maybe the two-day chart and maybe you get a more neutral picture. Capgemini is up by over 3.1%, but it's up 3.1% this morning. But the bias is definitely to the downside, and you've got some interesting themes emerging on the downside this morning. So let's talk about what we are seeing there. Stellantis down by 8%. Serious concerns emerging within the car sector this morning, not only from Stellantis, but also from Volkswagen as well. The French banks are starting to paint a picture of concern around what is happening with activity and what is happening potentially with the pricing in of higher energy prices as a result of what's happening in the Gulf. BNP Paribas in that camp, down by nearly 4% this morning. Agricole is down over 5.5% this morning. It is a tough day to be a French bank. Anna.
Let's get up to date then, Guy, on some of the other stories we're covering this morning. Shares of Bill Ackman's Pershing Square USA plunged 18% in their market debut after a combined IPO of the closed-end fund and his alternative asset manager. The deal raised $5 billion, just enough to keep early investors in, but far short of the $25 billion Pershing Square once targeted. Oil has spiked to a wartime high on reports the United States is considering new military options to attack Iran, with Brent briefly surging past $126 a barrel. Earlier, President Trump told Axios he won't lift a naval blockade on Iranian ports until he secures a deal on Tehran's nuclear program. And France's economy failed to grow while prices jumped more than expected to start the year. The data is a sign that Europe may be succumbing to stagflationary threats emanating from the Iran war. Guy.
OK, let's talk about how we factor that all into the central bank story here in Europe. The Bank of England and the European Central Bank, the ECB, are expected to keep rates on hold today. Policymakers playing for time as they assess the economic impact of the war in the Middle East and what that is going to do to the European economy broadly. Let's talk about how we've got this covered. Lizzie Burden is looking at what we are seeing with the Bank of England. Over in Frankfurt, we have our Chief Europe correspondent, Oliver Crook. We've got it all covered today. Oliver, I'm going to start with you. What is the data telling the ECB? The ECB has a single mandate. What are we looking at today? What is the message going to be?
Yeah, the framework around which the ECB is using to try to think about the different scenarios that we're getting because as a result of the Iranian sort of energy shock within Europe are the sort of the good scenario, the bad scenario, the ugly scenario, the baseline scenario, the adverse scenario, and then the sort of very severe scenario. And these basically have different expectations of where inflation is going to peak. The most benign peaks just over 3%. The middle one is just over 4%, and the sort of severe one is over 6%. We are getting inflation data across the European continent over the last couple of days. Out of Spain, yesterday, 3.5%. That's way above the sort of baseline expectation and coming way ahead of schedule. Germany, 2.9%. And then today, looking at the data that we got out of France, I mean, it's telling one very clear story, at least out of France, and that is a story of stagflation. We're talking about inflation coming into France, 2.5%. That's the highest level in almost 2 years. That is above what the expectations was by 20 basis points. And when you look at GDP coming in at dead flat 0%, that is 20 basis points below what growth was expected. So for the ECB Governing Council today, we're not expecting any move on the rate decision, but the real question, I think, for the Governing Council is how to basically portray this sort of inflation. How much of this is just going to be headline energy inflation that they can kind of look through for a period of time? To what degree is this going to read through to other parts of the economy, whether it's food, whether it's wages, whether it's all kinds of things? That is the real question for policymakers today. So for Christine Lagarde and the Governing Council, the whole sort of project of today is to keep inflation expectations anchored without tanking the economy and try to describe to people what kind of inflation they're expecting here in the Eurozone.
Yeah, because frankly, there is a stagflation risk, isn't there, for the Eurozone economy, as there is one for the UK economy as well. We're going to get the guidance, Lizzie. Let's bring you in at this point, but also potentially a split across the MPC. We saw that split at the Fed. What are you going to be watching for when it comes to the BOE later?
Well, as we've said, it's going to be a hold most likely. Traders only pricing in a 10% chance of a hike today from the Bank of England. That's because it's the same quandary here that Ollie was describing in the Eurozone. Higher inflation because of the war, but also weaker economic growth, or a subdued backdrop at least. And the big question is exactly the same. Will there be second round effects from this energy price shock? That's what's really concerning Chief Economist Hugh Pill here at the Bank of England. Others wondering, hoping whether you could see the weak labour market stopping that feedback loop when it comes to prices. So when it comes to the vote split, most economists see an 8-1 split, with Pill the most likely dissenter, but do watch out for the likes of Deputy Governor Claire Lombardelli or externals Catherine Mann and Megan Green joining that hawkish camp. Remember, those forecasts, updated forecasts that we get today, are the first complete set of forecasts that we've seen since the start of the war. Broadly, they're expected to show inflation above target for the rest of 2026, growth downgraded. But you could see the hawkish dissenters, if there are any, leaning on the more adverse scenarios here. Yes, the Bank of England is going to want to avoid the sharp market reaction we saw after the March meeting by trying to keep the guidance the same as the March meeting, where they said that they would stand ready to act if necessary. And remember, that guidance triggered that reaction. The gilt market so pronounced in the reaction to the Iran war, but you could still see those hawkish hints coming through when we get the individual comments from MPC members today.
Lizzie, thank you. Lizzie Burden here in London, Oliver Crook in Frankfurt, and we will bring you special coverage of the Bank of England rate decision and Governor Andrew Bailey's press conference. That's from midday today in the Bank of England decides, and the ECB rate decision is at 1:15 p.m. London time, followed by President Lagarde's news conference at 1:45. So plenty of coverage of those here on Bloomberg TV.
OK, let's get some more analysis now and bring in Janet Henry, Global Chief Economist at HSBC. Janet, good morning. Thank you for joining us this Thursday. How close is the Eurozone to recession right now?
Good morning. Well, as Ollie described, the ECB has got the good, the bad and the ugly scenario. And obviously we've just had the French release. We also had the Spanish release that wasn't quite as bad as the zero figure in France. But, you know, when you have a really low potential growth rate, it doesn't take too much to get to a stagnationary scenario, never mind a stagflationary one. So certainly as we move towards what was a good optimistic scenario whereby the strait would be open by now and things would be flowing, and go further into those bad and more ugly scenarios, that would certainly take you into a recessionary scenario.
What are the timeframes you're looking at then when it comes to those recession calls?
Well, I think a lot depends on whether we get any June rate rises, because at the moment the message that we're going to hear today from any central bank was don't panic. You know, we actually are going to wait and see. We don't need to rush into tightening. But all of the chairs are going to have a really difficult challenge, aren't they? It was a bit like Powell last night on the Federal Reserve. They have to speak for the whole committee. And when you've got three dissenters to an easing bias, and this could even be the issue for Governor Bailey today. Chair Bailey today, is, you know, if there's maybe one vote, but if there's three or potentially even four votes, then he has to speak for the whole committee and say why he is potentially, you know, he's got this divergent move and what will have to happen. So on the time frame, if the strait is still closed through May, then absolutely the likelihood of a June rate rise goes right up there. In our bad scenario, they would be raising rates in June.
Do you need to cause a recession to get inflation under control in Europe?
No, you don't need to cause a recession to get inflation under control. You know, what Europe's shown in the course of the last couple of years is that weak growth is no guarantee to very, very low inflation, even when you've got China trade diversion and you've got a strong euro. What you need potentially, and only time will tell how much, is that you need to show that you are willing to do whatever is required to keep inflation expectations anchored. A stitch in time prevents you having to do a lot more later. And this is where I think everything is framed by that 2022 period when interest rates were on the floor, and by leaving it too late, when inflation had picked up a lot, you ended up having to raise rates a lot more. Policy is neutral. And actually, if they need to send a signal now by raising rates early and potentially cut them again by the end of the year, then that's what they would rather do than potentially leave it way too late and have to raise rates to 4 or 5%.
But these scenarios feel very different to me.
Yes.
You got to. Then you had strong demand.
Yeah.
You don't now. You've got a cost push story that is very different, and I don't know how central banks. You can't print more oil. How do you control inflation if you are the ECB? How do you get it other than basically demand destruction? There is no way of controlling inflation expectations or inflation. The picture's different.
The picture is very, very different, and it is an outright supply shock. And this is when the timing is obviously very, very important. At the moment, it's mainly about the price, and certainly in the advanced economies, but in a lot of emerging economies around the world, it is an outright supply shock. You can't get some of these oil-related goods for any amount of money, and you are actually seeing a curtailment of supplies, whether it's gas supplies in India or other oil-related products in other countries. And so you're absolutely right. You can't, which is why for as long as they can, they will send the message that we don't need to rush into anything, but they'll be looking not just at financial market measures. There'll be a lot of attention on the ECB price expectation survey. We've seen it in the UK with the YouGov City expectations. They've spiked up. Households are much more nervous about inflation. Companies have seen that inflation is an issue. They look to push through the price increases. They're not going to take a risk with their decades-earned inflation credibility by sitting on it for too long.
OK, so does that mean, so the ECB then, so that's why you're focused on June then, perhaps, and any guidance around June and whether we get a hike in rates in June? I mean, I guess I'm thinking about the ECB, but it could apply to other central banks here. Are central banks going to accept that? I mean, they'll get criticised whatever they do here, won't they? They're going to hike in the short term, not today, maybe June, hike and then have to cut later. And some people will call that a mistake and say that was a policy error, but they'll just have to accept that that's just what you have to do in this situation. Is that how things will play out?
That certainly is one scenario, and you're absolutely right. If they do have to raise rates once, maybe twice, and you get to the end of the year where they're cutting it, everyone will absolutely say that was a policy error. But you never know what would have happened in the absence of having raised rates in the near term. And they can't give us any clear guidance on June because they don't know whether the Strait is going to reopen in the next few days or at the end of May. So just what happens in terms of the reopening of the Strait, even if we know that it's going to take 2 months or so before everything gets back to any kind of normality, at least they've got some visibility. But if everything's still shut down at the end of May and inflation expectations are getting elevated and they are concerned that their credibility is questioned because none of these central banks have been back sustainably to their targets in the last 5 years, then yeah, they would have to react towards that.
The ECB got there, didn't it? But maybe not sustainably, to your point.
Right. The ECB did get there. The Fed hasn't, and the Bank of England hasn't.
What about, so Eurozone inflation expectations then? They did jump, and I think you've been referencing this already, Janet, up to 4%. How long do they have to stay there before the ECB has to act? Or is it actually just a case of, well, as soon as the Strait of Hormuz opens, that will drop again, so they just wait another month and hope?
Well, all central banks look at a whole array of inflation expectations, and financial market measures obviously move to every dollar move in the oil price. Households, the surveys tend to be monthly. They look at the whole breadth of surveys, but then they look at other data that they've got, whether it's the survey data or the hard data of it feeding through, and they also look for any early indications that they've got on wage growth. So, for instance, on the Bank of England, the decision makers panel, it's roughly balanced in terms of the number of contributors to that survey that are saying wages will rise, but is more people saying that wages will rise than will fall at this point, even though, to your point, the labour market is in a very different position to where it was in 2022. So they look at the whole jigsaw puzzle of the hard data and the soft data, but the early indicators they get will be from the inflation expectations and just looking at what's happening in the Strait of Hormuz.
Yeah. They're doing the jigsaw puzzle without the box, which makes life a lot more tricky. Janet, nice to see you. Always start with the corners.
Do they lose pieces?
Well, maybe.
As well.
Yes.
Haven't some pieces been lost already?
Yeah, I think so.
Yes.
The dog ate some.
I'm not sure we're going to end up with a full picture. Okay. Talking, Janet, nice to see you. Thank you very much, Steve, for joining us. Janet Henry joining us from HSBC. We've been talking about this all morning. It looks like we have a technical glitch at the IBEX. That is what the exchange is now talking about. You've got quite a big picture, a divergence between the futures and the headline price. There's a lot of ex-dividends going through that market this morning, and I just wonder whether there's a little bit of a calculation problem related to that.
OK, from one angle on tech to another angle on tech, because a frenzied day of earnings reportings, of course, offer a glimpse at how some of the world's biggest tech companies are shaping up. We're going to break down the numbers from the mega-cap tech names stateside. That is next. This is Bloomberg.
A cidade estava sitiada.
Isso ao começo eu não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering, and someone is driving a Range Rover with their money. Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Let's turn now to a raft of US big tech earnings literally crossing the line in just a couple of minutes yesterday. Amazon, Alphabet, Google seeing a clear payoff from their AI spending, while Meta is lagging behind. They are collectively now pledging to spend $275 billion just this year on CapEx. Let's bring in Matt Block, some senior analyst at Bloomberg Intelligence. What were the clear reads for you in terms of whether or not this spending is paying off? Who is winning, who is losing?
Yeah, I mean, I think we're still very much in the investment phase, and the payoff phase is still kind of somewhere in the future. You know, I mean, obviously Google or Alphabet was the standout, delivering much better than expected revenue growth in their cloud services business. I think you have to put in some context that it is the number 3. It's a smaller business than either Amazon or Microsoft, so you would expect it to be growing. But I think overall, you know, people see that, you know, this is a business not so long ago. People were worried that, wow, that they're an ad-funded business, and yesterday's news in terms of search is going to change. These guys are going to be left behind. They've done a great job of integrating AI into their core products, and it's adding fresh momentum to it. And they have the cloud services, and they have the chip story, and they have YouTube. So I think overall, you know, there's a kind of lots of engines of growth there that people are feeling optimistic about. Compare that obviously to Meta, where it's a much more narrow focus. We were just talking about this primarily ads-focused business and lacking clarity in the monetization opportunity, increasing spending, bigger question marks about the payback.
And I was just laughing about this. Yes, there's a lot of going on the call.
There are.
From Zuckerberg.
Yeah.
That's got to be worrying, isn't it?
Yeah, I think people just don't see the clarity coming through in terms of how they're going to monetize the opportunity, and they put through some of the biggest spending increases, and the spending increases were more because their input costs for that CapEx are going up, not because they're necessarily chasing a bigger revenue opportunity, so there's inevitably a bit of a return on investment squeeze there.
Yeah, that seemed to be, and that wasn't just Meta though, that was elsewhere as well. In some cases, CapEx was going up because they were just having to cover the costs of higher components, higher memory chips and the like.
Yeah, we saw a big increase at Microsoft on the CapEx side. I think for the others, people are giving them a bit more the benefit of the doubt that there is clear end-user demand coming through, particularly from enterprise customers for cloud services, and that they're spending the money to kind of enable that revenue to come through. And I think that story is clearer in the businesses away from Meta.
What about Apple? It has not been following this cycle of CapEx spending around AI, and they report today.
Yeah, they do. Yeah, I think there's two or three things that we're really focused on. One is just the strength in the product revenue. I think it's going to be a great quarter for them. You think about they had the Neo, the 17E, and a bunch of other products.
These cheaper laptops, that really kind of taking a shot at the PC.
Exactly. Yeah, and they've been a huge success, and that kind of tied to one of the other things, which is the CEO transition. Very much the new CEO is kind of behind the success of the Neo product. I think so there's going to be optimism from the market about a stronger edge to Apple's products going forward under the new CEO. The third thing is obviously coming back to chips and margins. Input costs are going up. How well is Apple managing those higher input costs, and can they pass that on to the end consumer? So do they have some kind of margin protection?
Matt Bloxham, thank you very much indeed. A great setup in terms of the preview around Apple and the wrap in terms of the numbers that we got out yesterday. Senior analyst at Bloomberg Intelligence. Let's look ahead at what else we are watching throughout the day. Then 9 a.m. UK time, we're going to get Italy and Germany GDP for the first quarter after France came in flat a little later on at 10 a.m. Euro area GDP, first quarter, CPI as well, so inflation out of Italy. And at 12 p.m., of course, it is the BOE rate decision. At 1:15 p.m., meanwhile, we're going to get the ECB rate decision. And at 1:30 p.m., we're going to get US first quarter GDP and jobless claims, the labour market in focus out of the US, and on the earnings front, as we mentioned, Apple.
Let's talk about what is still ahead then for today. As Tom's just been talking about, the ECB and the Bank of England rate decision loom large on the agenda. Skylar Montgomery-Koning from Bloomberg's Markets Live team with us on set. So Skylar, the market's thinking around what to expect from the Bank of England and the ECB has been evolving a lot this week, you say. Has the direction of travel just in the last 24 hours, though, just reflected the fact that we were up 5% on oil yesterday, another 3% higher on oil today? This just has to increase people's expectations of hikes, does it?
I mean, that's absolutely it. So at the start of the week, it was very clear to me that heading into these central bank meetings, the risks were skewed hawkishly and you'd likely see higher yields. Now we've had a week of price action, and if you look at the ECB and Bank of England pricing 12 months out, there's something like 20 basis points that have been added to both this week. And that's because, as you say, energy prices have risen quite considerably. They've just kind of surged higher today. Yes, we're having the contract roll, but we're at a level that we haven't seen in a very long time. And that just really tells you that's what matters for bond markets right now. It's feeding into your expectations for central banks. And so, you know, from this meeting, because we've had that hawkish reevaluation, maybe risk are skewed a bit more dovishly on commentary. But that dovishness can't sustain any kind of upside in bonds if energy prices don't come down. So certainly if they keep rising, it can't.
What looks, started to see some quite extreme numbers. Yen, 160. US 30-year, 5%. UK 10-year at 5%. How extreme are these? There's a lot of chat about some of these levels and how kind of significant they are. Are they?
Yeah, I mean, let's talk about the UK, for example. The UK yield, if you assume in line with market pricing that they hike to 4.4%, somewhere around there, and then stay there, you compound those forwards and add a term premium in line with the ACM of around 110 basis points.
Wow.
That gets you to a 5.5% yield.
Yeah.
So it's not an unjustified level of yield that we are currently, and you can certainly go higher. Maybe if we get a little bit more hawkishness today, although that seems less likely given the shift in pricing we were talking about. But certainly if the vote split skews more hawkish, we're going to have inflation revised up. Growth is going to be revised up likely as well, because the first quarter was quite strong, even if it's because of seasonals, even because of its front loading. And we have politics next week being an issue. So I don't think these extremes are necessarily the limit.
Politics is an issue in the US as well as we count down to the midterms. We've got data out later today. California gas prices, gasoline prices in some parts of California, $7 right now. And California has its own higher costs, obviously, versus other states. You're looking at the data out of the US later today. How much is inflation going to come through there?
I mean, quite significantly. You get the PCE price index, and your core measure for that was already at 3% and struggling to get sustainably below that, and it's going to rise to 3.2%. And so that's not even your headline component, which is where you really see that kind of gas and oil price move feed in, and that's really worrying for the Fed.
So core 3.2?
Yeah.
Yeah.
Like, that's quite worrying, right? And that tells you why you got that shift from the Fed last night. And I think it says a lot that the market is still only pricing a little bit of hike, as in we're still kind of counting on, or the market is counting on, this dovishness to come in through Kevin Warsh, but you have Powell staying on. You have three members now thinking about hikes a lot, so it's worth considering. We will be considering it, and you'll be writing about it, no doubt, giving you analysis on the M Live. Skylar Montgomery Coding, of course, with that analysis. Capgemini's CFO is coming up 9:15 a.m. UK time, so stay tuned for that. That is it for the opening trades. The Pulse is up next. This is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Oil rallies to a wartime high after a report that President Trump is set to receive a briefing on new military options in Iran. A frenzy of big tech earnings, Alphabet jumps as Google delivers a clear payoff from its AI spending, but Meta tumbles on plans to increase capex up to $145 billion this year. Plus, the Fed holds rates in a split vote as Kevin Warsh moves closer to becoming the next chair. We're also expecting no change from the Bank of England and the ECB later today. So there is a lot going on. Overall, look, a lot of the focus, of course, is on oil, but stocks also falling, as well as jumped to the highest since the Iran war began. It's definitely adding to a lot of worries about inflation. The global benchmark, crude oil, for Brent actually climbed to $126 a barrel, hitting the highest intraday level in about 4 years before paring some of that advance. And it's also, of course, another busy day of corporate earnings. Traders also focusing on central banks. We're not expecting a big move today, but we're expecting them to guide us towards what they could do in the summer. Now, we also get some data out of Germany. Preliminary first quarter GDP rising some 0.3% quarter on quarter, a touch above estimates. And then in Japan, the Japanese finance minister is saying they're nearing timing to take bold action on FX. Again, if you look at the impact the price and the rise in oil has had, it's really a lot of the Asian economies that are taking most of the brunt. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, oil at a wartime high. The U.S. is reportedly eyeing new military operations in Iran. The Bank of England and the ECB decisions later today after the Fed held. Now, we break it all down in just a moment with Soren Rade from Point72 and Ian Steely from JP Morgan Asset Management. But first, we begin with U.S. big tech earnings as well. Amazon and Alphabet's Google are seeing a clear payoff from their AI spending, with Meta lagging behind.
We are increasing our infrastructure capex forecast for this year. Most of that is due to higher component costs, particularly memory pricing. But every sign that we're seeing in our own work and across the industry gives us confidence in this investment. That said, we are very focused on increasing the efficiency of our investments.
Our ability to invest in this moment and stay at the frontier, I think puts us in a strong position. And I think we are doing it based on tangible demand signals we are seeing.
Well, let's get more now from Bloomberg senior strategist Neil Campling. Neil, good morning. What have we actually learned about how much the Mag 7 investment in AI is actually paying off?
Good morning. I think if we have a look at the growth rates of the businesses, that gives us an indication of whether these investments pay off. And quite simply, Google Cloud grew 60% year on year in the latest quarter, and their backlog in terms of revenues that haven't even been posted yet grew 100%. So I think that is an evidence that they are getting good returns on those investments. In contrast to that, we have Meta's sales that are half of that kind of growth rate, whereas their capex is growing at around 3 to 4 times the rate of growth of their actual sales. The other companies in this space, of course, with the big 4 hyperscalers, are enjoying accelerating growth. Azure grew 38% for Microsoft in the latest quarter, a very good number for a very large installed base. And AWS enjoyed its fastest growth in 4 years, growing 28%. So I think we've got 3 out of the 4 companies that are enjoying very good top-line results on the back of the investment, whereas really there are lots of questions being asked around Meta in particular, because the rate of growth that they have in terms of their capex is absolutely very significant.
Yeah.
We're looking at over 100% growth year on year for their capex.
So Neil, what can we expect actually from Apple's results a little bit later?
Yeah, from Apple, of course, we've got some of the new products in terms of sort of the lower end, cheaper MacBooks coming out. We're going to have, I think one thing we're going to look at is what are the impacts of the increasing component costs. We've discussed before about memory pricing, and we've seen a 45-fold increase in Samsung's memory division profit this morning. So does that start to impact in terms of the profitability from Apple tonight or going forward in the guidance? It was the guidance last quarter that worried some people that component costs were going to start impacting whether consumer demand for raising pricing or whether it impacts those super normal margins that Apple really enjoys.
But thank you so much, Neil. As ever, Bloomberg senior strategist there, Neil Campling. Now, the Bank of England and the European Central Bank are expected to keep rates on hold today. Meanwhile, the latest data shows France's economy failed to grow while prices jumped more than expected. Now, with us now, Soren Rade, head of European Economic Research at Point72, and Ian Steely, International Chief Investment Officer for Fixed Income at JP Morgan Asset Management. So thank you both for joining us. Ian, let's start with you. When you look at, this is about military options, actually. We worry about the price of oil and therefore inflation. So I don't know how much central banks can actually guide us into what happens next. You have to be a military strategist to try and understand this.
Central banks are in a really tough spot at the moment, and ultimately they're looking at an environment where, yes, prices are going up, they're too high, particularly in Europe, where we know the ECB has the single mandate of price stability, and the Bank of England sort of has that same mandate, although maybe looks a little bit more at the economy as well, rather than more than the ECB does. But they're both very fixated on this, and they want to make sure that what they do is seen to be inflation hawks. They seem to be under control. Long-term inflation expectations can't become unanchored. So that has to be their priority. But I do think that they're going to be measured in their response, because ultimately this is also a tax on consumers and is likely to have a growth impact down the line.
Yeah, and Soren, again, the problem is with the headline saying, look, the U.S. is mulling some options, military options in Iran. Again, you don't know what happens to the price of oil. You don't know what kind of impact it has longer term, so you don't know whether central banks should look through it or not.
Absolutely, and I think that's precisely why the message that we got in the weeks leading up to the meeting today, especially from the ECB, was there's a high option value of waiting to ascertain which scenario among the ones they laid out we're in. Are we in a prolonged closure of the Strait of Hormuz scenario? Are we in a high oil spike scenario? Or are things settling down?
But so who can tell us? And again, if you look at fixed income investors or what the fixed income market is saying, it's a different story to what equities are looking at.
They are, and I think the problem we've had is a couple of Fridays ago, it did feel like we were heading in the right direction, and we described it as 2 steps forward, 1 step back is how the process would go. It feels like we're taking a few steps back at the moment, and it does feel like it's going to be a bit more drawn out than we'd expected. So as you said, it's likely that we're moving from the ECB's base to sort of more the adverse scenario. Ultimately, that does mean that they're likely to have a hawkish bias. The question is, there's a lot already priced into the markets, and I think we have to, from a fixed income standpoint, look at that and say, OK, maybe we see a couple of hikes from, say, the ECB or the Bank of England. Are they really going to manage to do 3 or 4 consecutive meetings? That's the second half of this year. If this is continuing for a long period of time, we're going to see an impact on growth by that point.
Yeah, Soren, I guess you could also argue that if AI accelerates and it's kind of deflationary or disinflationary, and then you're in a situation where the war in the Middle East hurts growth and then they actually have to cut, is that possible? Is anything possible at the moment, or is the next move definitely a hike?
I'm not going to go on the air and say something's not possible in this environment. I do think that, AI as a near-term driver, I doubt that is a big disinflationary force in Europe. So I think those inflationary risks really dominate. But as Ian was saying, there is a cost to be paid on the other side, right? This is a supply shock. So it is a trade-off. I do think that the balance of evidence at the moment weighs more heavily on the inflation side. And so therefore, central banks worried about inflation anchoring will respond to that, although I suggest ECB and BOE are in different starting positions.
Yeah, and then if you look at the Bank of Japan, I mean, they have a whole other set of issues. We just heard, Ian, from the finance minister warning about possible intervention in the currency market. And I have to say she was, pretty bold about that, saying that the timing for taking bold steps is nearing. The yen fell to the weakest level since mid-2024, again, after the Bank of Japan and the Fed held policy settings stable. But, do you worry about Japan? We're talking about FX intervention.
Well, I think, as you said, the currency's got very weak. They are effectively an energy importer. They're a food importer. They've got to be concerned about this level. Again, they're a very measured central bank. The reality is they probably should have rates higher than where they have it at the moment, looking at where their inflation profile is, but they don't really want to cause unnecessary market volatility. But if that's the case, then the currency's not going to like it. And as you said, we've seen the depreciation there. So I can understand what they're trying to do. Actually, they should be taking policy higher because it's just too low at the moment.
But how much? I mean, higher oil prices, again, because of the Middle East conflict, have undermined also, the yen because of the reliance on oil. Do we spend enough time really realizing how tricky it is for a lot of these Asian economies?
Yeah, it's a really tough spot, and we've already seen some of the headlines out of Asia and some of the restrictions that are being put on in place there. So it definitely feels like that is being the place that's impacted first. Then it's coming over to Europe, and then ultimately the US does seem to be a little bit more contained. Although you look at where gasoline prices in the US are, it's not completely immune to what's going on at the moment.
So, Søren, do you look at things regionally as well?
Absolutely. I think as Ian just described, that cadence is exactly right. Starting points are certainly different. I mentioned differences between the UK and Europe, with Europe essentially a target with inflation, the UK well above. US insulated in the first instance, but probably not down the line, and with, I would say, underlying inflation still not under control.
Do we have to talk a bit more about what China's doing in all of this? Because they also have an oil importing problem, but they don't seem to want to weigh in also from a geopolitical standpoint.
If you think about China, China's got huge reserves of oil. So in a sense, they do have something to fall back on. And you're hearing headlines that possibly they're going to release some reserves to help out other parts of Asia. So yes, I think China's actually going to be a big player, and I think ultimately they could become a big player in how this all gets resolved, because in the end they are a big user of oil, and they are going to need oil to appear at some point. But they've very strategically built up their reserves over the last few years.
Søren, what are you expecting from the Bank of England today? Again, this is a small open economy. It's extremely impacted by the price of oil. And to start with, there was stickier inflation than elsewhere in Europe.
Absolutely right. For that reason, rates also haven't fallen as much. And I think that's, in a sense, what's bailing out the BOE at the moment. They are still at, I think, what most of them in the committee would agree, at restrictive rates. So the need to respond immediately is perhaps a bit, or the urgency is perhaps a bit less pressing than elsewhere. So we expect them to be on hold today.
What are you expecting in terms of the vote split? I mean, I feel like maybe the vote split is a bit like the lottery, but are there going to be more hawks?
I think that the reality is you're probably going to get a couple of dissenters. Hugh Pill looks like the obvious person, and then maybe you get Green, possibly Mann. Let's see on that. I think the most important thing for the way we've thought about it is the outcome from the last meeting probably wasn't what the Bank of England were hoping for. I'm sure they knew the direction of travel that the split or the shift in sentiment would have been, but maybe the extent of the move. They've obviously, and Bailey in particular, has spent the best part of the last few weeks trying to soothe that, trying to walk that back a bit. What they probably don't want is another repeat of that. And again, there's a lot priced in to the Bank of England. And again, particularly where the economy is, completely where the labour market is, I think they are going to be looking at the growth side. That said, the data hasn't really helped the Bank of England over the last couple of weeks or so. It hasn't sort of shown maybe the declines that we've seen in Europe.
But Ian, you talked about it, right? There was a little bit of an outsized, I guess, market reaction after that March meeting. Why do you think that is? Was it positioning in the markets, or were they looking at world events?
I think there was obviously a change in tone from the Bank of England. I mean, you've got Deputy Governor Ramsden saying he would have cut had this not been going on. I think there were maybe some people who were still expecting a couple of people to possibly even, still have cut in the books, and that wasn't the case. And then obviously we knew that there was very heavy positioning in the front end of the UK. It was the place where it looked like the employment picture was slowing. It looked like inflation was going to be heading back to target later this year. There was only at the time a couple of cuts priced. People felt they could do more, and actually there was very big positioning because it wasn't going to be a big move, so you actually had to take size in that. Now a lot of that has unwound. I do still feel that there is quite heavy positioning in the front end of the UK, and there has been some re-engagement of that over the last couple of weeks or so.
I mean, Soren, how difficult is it to model inflation? So I think we have a viewer question. I had my own question on, if you look at what we're expecting from the Bank of England, certainly Bloomberg Economics thinks we could get some kind of inflation forecast peaking around 3% at the end of the year, and then on the medium term, it comes down. And then this viewer, thank you for writing in questions because we love engaging with you. Do you model in Trump possibly putting export controls on oil? I mean, this is all about modeling. This is not about probabilities anymore. It's scenario planning.
Absolutely. And the BOE will very likely follow the example of the ECB, come up with scenarios. I am not so sure they lean very heavily on a baseline scenario and signal a great degree of confidence.
Yeah.
Like the ECB, they have a strong baseline and then they have scenarios on top of that. I expect the BOE to be a bit more open-minded to the adverse scenarios that they're likely going to show. I suspect they will be more price-driven than really driven by physical supply constraints.
I am getting a lot of questions, again, more questions from viewers on oil. Do you think it's possible, I mean, export controls on oil, from the US would be a big deal. Who would suffer most? Asia first and then Europe?
So Asia first. I think in Europe, one of the issues we have, there was, reporting out this morning, the EU Commission is making an effort to ascertain how much reserves do we have in Europe? And the answer is we don't know. We don't have visibility beyond a couple of months. So I think that is really a worrying scenario, and that is, I don't think, one that people are contending with. Like I said, it's treated like a price shock.
Yes, so what the markets aren't really pricing the downside risk, right? They're staying in this kind of optimistic middle ground. Is that fair?
So I think on the growth side, that's definitely fair. Yeah. I think the inflation side is probably well priced, and inflation pricing has moved up to reflect that. But on the growth side, that's where, yes, I see downside risk.
So given all of what we've talked about, what do you buy today in fixed income?
So I think we have seen a big repricing, and I do feel that you're in an environment where the front end of European yield curves are probably overpriced. If you take a sort of an average or a median of what should be occurring over different scenarios, I don't think we're going to get 4 hikes coming out of Bank of England or the ECB if this continues. And I think that ultimately we'll focus on growth. So I do think there's an opportunity there. I do still feel that fundamentally corporates are in a really good spot. Now, of course, if we have a global recession, they're going to be challenged on that. But ultimately, if you look at where earnings are in the US, they're very strong at the moment. It's very rare that you actually see earnings get revised up as you sort of go through the quarter. So corporates in a good health. The repricing in yields, I do think it's a good environment to be owning some bonds at the moment. But we do need to be mindful that if this continues, if oil prices continue to go higher, then ultimately yields will go higher in the near term.
Okay, thank you both for joining us. Soren Rade, Head of European Economic Research at Point72, and Ian Steely, International Chief Investment Officer for Fixed Income at JP Morgan Asset Management. Now, coming up, we'll talk to Naif Bhagat, Capgemini Chief Financial Officer, about the IT company's latest sales numbers and challenges of conflict and AI. That's coming up next, and this is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Middle East tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
The Bank of England makes its next interest rate decision against the backdrop of conflict in the Middle East. Investors will look to BOE Governor Andrew Bailey for signals on the rate path ahead.
Our next decision is at the end of April. A lot will have happened.
Tune into Bloomberg for live market reaction and analysis from the studio and on the ground at the Bank of England. It all starts today at noon on Bloomberg. Context changes everything.
Well, despite economic uncertainty and the impact of AI and the IT industry, Capgemini's first quarter sales outperformed analyst expectations, particularly in North America and Asia. Well, Nivi Bhagat, Capgemini's Chief Financial Officer, joins us now. Ms. Bhagat, thank you for being with us. When you look at geopolitical uncertainties and everything that we're actually living through with what's happening in the Middle East, are rising tensions actually driving spending in security services?
Well, we've had, of course, as you saw, Francine, a very good quarter. And of course, yes, the momentum came from a number of different geographies. We haven't necessarily seen any particular impact at this stage from the Middle East because it has not really impacted the group revenues. But as you can imagine, we are watching that very carefully and being very vigilant. But is there more spending in the area of security and defense? I'd say yes, and that happens particularly in Europe, where we're seeing quite a bit of it. And we're, of course, very well positioned to take that, considering, of course, we have a European heritage. We have a lot of scale and digital solutions to be able to do that.
So what does it mean for companies right now? Are they cautious about launching either something transformative or some of the innovative projects with you, or do they keep on spending and accelerate? What do you think is going through their minds right now?
Well, they are looking at a combination of things. So they're looking at both the cost takeout sort of initiatives, and they're also looking at transformation initiatives. And particularly when you look at AI, since that's the topic in everybody's conversation, they're looking at it from the perspective of, should they be looking at things which are beyond just cost efficiencies to business outcomes? And therefore, should they be preparing, if you like, their entire tech stack to, be prepared for that? So should they be working on their processes, on data, to be able to architect all of that better, to be able to prepare for it. So there is a mix of both. There is the cost takeout to be able to fund the transformations, and there is the start of transformations as well.
So what kind of transformations? Is there, if you look at the market, what's the most dynamic part of the market for you right now?
So there's a lot of spend on a few areas. So there's data, there's AI, and as I said, there's a lot of spend on defense as well, and there's spend on digital core. So let me explain this. So when you look at wanting to get into AI in a way that will really impact business outcomes, it's very important for clients to look at their tech stack, which has really not been touched for a very long time. So there's a lot of tech debt sitting there. So clients are looking at what can they do about processes? How do they hyper-automate these processes? How could people like us, for example, take them over, and automate them right down to the microtask level and give them insights which will then help them make the business decisions in times like this, for example. It's also about how do they re-architect their data, because a lot of this data is old, hasn't been cleaned, etc. So what do you do with this data? And they're looking at that very carefully. So we see the transformation there as well. And there's a lot of back-end systems, if you like, on the digital core side of things, which they need to sort of reimagine, re-architect for them to be able to get the right insights. Because it's only then can you start to put the true agentic AI, if you like, as a harness across the organization. And from that perspective, therefore, there's a lot of, preparing readiness to be able to sort of seize, if you like, business outcomes as they go forward.
Because you're a big global company, by geography, is there part of the world that feels like they're ready to spend more or are embracing AI more? Is it the US, Asia, or Europe, or anywhere else?
Well, I'd like to say the Anglo-Saxon world is spending a little more on the AI than the rest. Not to say that the rest is not looking at it, but there are various stages to this. There are clients who are in the proof of concept stage. There are clients who are doing sort of AI factories, and there are clients who are looking at sort of what I call the real AI use cases that are going to impact business outcomes. You see a bit more of the last category across the Anglo-Saxon world, and you tend to see sort of the first two categories maybe outside of that in continental Europe and other parts of the world as well.
And going back to AI, I mean, you're saying that customers are they fully in AI, or are they waiting also for the next iterations? Do you think their CapEx is invest now and then think later, or are they going a little bit more slowly and so CapEx can increase in 12, 24 months?
Well, it's a combination, because as I said, a lot of them are realizing that the real benefit of AI is in AI transformation in true business outcomes and business cases. And in that context, they're preparing themselves for, that leap ahead. Some industries, of course, making that leap faster than some other industries in terms of what needs to happen. But everywhere we see clients now having conversations about how you prepare that tech stack, if you like, for the, for agents and agentic harness around that tech stack to be able to make that happen. So you're seeing quite a bit of that preparedness and getting ready for the, for what I call the big AI use cases, which then impact business outcomes in a client's business going forward, or essentially a game-changing aspect in their own industries.
I know Capgemini was also criticized a couple of months ago because of contracts that you had with ICE in the US. Where are you in the process of divesting that unit?
So as you know, we put that company up for sale, and we wait for the process to conclude. So we've got, of course, expressions of interest, and we wait for the sale to go through.
Okay, thank you so much for the update, and thank you so much, as always, for coming on Bloomberg TV. That was Nivi Bhagat, Capgemini Chief Financial Officer. Again, a lot going on in the market today. The main focus is, of course, on oil, given everything that we've seen in the last 12 hours. Oil hitting a 4-year high. There are reports that the U.S. is mulling options in Iran, military options. Now, again, the U.S. and Iran have maintained their blockade of the Strait of Hormuz, with the conflict in the Middle East called the biggest supply shock in history by the International Energy Agency. Coming up, we talk more about oil, and of course, we'll have the latest on the Strait of Hormuz blockade. That's next, and this is Bloomberg.
We should not deny that change is coming. And change is not coming just in data centers and AI. As a world, we are building infrastructure, we're building energy, we're doing energy transmission, we're building next-gen manufacturing, we're ramping defense, and we're doing this thing called AI and data.
Yes.
We will see the largest need for capital ever. And that's what we've seen so far this year. And so now to your specific question, it's about underwriting. There are a number of very strong US tech companies who run diversified businesses, Amazon, Google, Microsoft, who are interested in seeing these centers built and are interested in not consolidating the debt on their balance sheet. And to the extent they are prepared to lend their credit, one can lend against those types of things and make sensible underwriting decisions.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate.
More than what you need to know, it's what you need to think about.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Oil rallies to a wartime high after a report that President Trump is set to receive a briefing on new military options in Iran. A frenzy of big tech earnings. Alphabet jumps as Google delivers a clear payoff from its AI spending, but Meta tumbles on plans to increase capex up to $145 billion this year. Plus, the Fed holds rates in a split vote as Kevin Warsh moves closer to becoming the next chair. We're also expecting no change from the Bank of England and the ECB later today. So oil has spiked to a wartime high on reports that the U.S. is considering new military options to attack Iran, with Brent briefly surging past $126 a barrel. Well, earlier, President Trump told Axios that he will not lift a naval blockade on Iranian ports until he secures a deal on Tehran's nuclear program. Let's get more with Bloomberg's Jumana Bersechi in Dubai. Jumana, good morning. So what do we know about these potential new U.S. plans?
Yeah, well, Francine, what's become apparent in the last 24 hours is that President Trump has no intention of lifting the U.S. naval blockade. And actually, in an interview with Axios yesterday, he said that the blockade was more successful than bombing. And this, again, complemented by U.S. Central Command earlier this morning, saying that they had caused 41 commercial vessels to turn around on the back of this blockade. So remember, at the beginning of the week, there was perhaps some hope that there would be a Straits reopening. It's become apparent that that is not going to happen. And indeed, Axios also reporting overnight that later today, the head of the Central Command, this is Admiral Cooper, will be having a meeting with President Trump whereby he's going to present to him 3 potential military options. And according to this Axios report, those 3 options include short and powerful strikes on infrastructure targets, taking over part of the Strait of Hormuz to reopen it for commercial shipping. And then the third option would be a special forces operation on the ground in Iran, whereby troops would be deployed to go and extract that highly enriched uranium. Now, we don't know whether the U.S. is going to go down the military route, but of course it is within the realm of possibilities. But just to add to that as well, Francine, the U.S. Central Command have also requested for the first time ever for the Army to send this Dark Eagle hypersonic missile. This is a super missile, 5 times faster than the speed of sound, that has never been deployed in the region. And the rationale would be it would be used to target some of those ballistic missile launchers deeply embedded in the mountains of Iran, not used before, but just another sign that the U.S. are increasing their military assets in the region should they want to go down the path of hostilities once again.
Jumana, what's been the Iranian response?
Well, defiance, as ever. And overnight, one of the key military advisors to the supreme leader said that as long as the U.S. naval blockade persists, then they will have to respond somehow. Unclear what that type of response would entail. And then the Speaker of the Parliament, Mohammad Galimov, who was also the key negotiator from the Iranian side, has said that Trump is trying to force them to surrender through a combination of factors. One, economic pressure, and two, presenting the Iranian side as being internally divided. And actually, I would say that President Trump would probably agree with that, because he does think, and there is a view out there, that the U.S. naval blockade is working. It is actually sustaining a lot of damage to the Iranian economy because they're not capable of physically exporting their oil out of the country, or at least if they are doing so, it's in a diminished capacity. And at the same time, it is unclear from even our own reporting who is actually calling the shots right now in Iran. President Trump has described leadership as being fragmented, coming under pressure. He's saying that they can't get their act together, and very close to a state of collapse. So time will tell whether that actually is the case on the ground. But once again, the messaging coming through from Iran is one of defiance as opposed to capitulation. And so what you're seeing today in markets is accounting for the fact that as we head into a weekend, and this tends to happen over the course of the weekend, there could be once again a resumption of military action.
Jumana, thank you so much. We'll, of course, keep on top of this. Jumana Bersachi there in Dubai. Now, Spanish GDP was higher than expected in the first quarter, but the country's inflation has unexpectedly jumped further beyond the ECB's 2% target. Carlos Cuerpo, the Spanish economy and deputy prime minister, says the country is more resilient to higher fossil fuel prices because of its bet on renewables. But he also warned that as the Iran war drags on, it may start impacting the tourism sector heading into peak holiday season. Well, I spoke exclusively to him on the sidelines of Bloomberg's City Lab event in Madrid.
Since the very beginning of the war, we've been very attentive to the first line of impact, which was energy prices, fertilizers as well. And 20 days after the war started, on the 20th of March, we already had a pack of measures in place, 5 billion to help households, firms, energy-intensive sectors deal with the increase in prices, and also the agricultural sector, because these 2 months are key for the next season crop. So we knew that we had to help them with fertilizers as well. And this is helping us navigate through these initial phase of the war. For example, today we had the data on inflation for April, which was 3.2 for Spain. Basically, we've made the estimation, what it would have been without our measures in place, 4.4. So that's by how much our measures are helping households and firms in our country. But in any case, big question mark is, of course, the duration. And that's what's keeping us, also, of course, very worried, because it's not just about prices, but potential additional issues, like, for example, jet fuel, which for Spain is a key element for our tourism sector. So we don't have a specific issue in Spain because we have 8 refineries. We only import 20% of our jet fuel. But tourists will come from other countries with other companies. So we need to deal with this with a coordinated approach.
But how do you see, first of all, the war with Iran ending? Spain has taken a very different stance to other countries in Europe and in the world.
Well, you know, since the very beginning, we've had a very clear position against this illegal war in Iran that was started unilaterally. And what we're demanding at this point is to put an end to it and do it via diplomatic channels, as we hope will be the case with the conversations that are ongoing. Although let's see in the next few days, in the next few weeks, whether this is the case or not. In any case, even in the best case scenario of putting an end to it right now, it will take months for the situation to go back to normal.
Carlos Cuerpo there, the Spanish economy and deputy prime minister of Spain. Now, major French banks have been reporting this morning was a beat from BNP Paribas and Société Générale, but a miss from Crédit Agricole. Now, the CFOs of BNP and Crédit Agricole told Bloomberg that they've increased provisions in the first quarter to combat macro uncertainty.
So it's possible that there's going to be a couple of rate hikes. It could be that that is because there is inflation, so GDP growth could shrink a bit. But GDP overall would remain, in our view, would remain positive, yeah? But there is this uncertainty, and we haven't seen it with our clients, we haven't seen it in the results. Nevertheless, we took a macroeconomic provision in the cost of risk in anticipation if the situation could be continued.
Our corporate loan production is growing strongly in France. In Italy, you know, Italy is our second domestic market. Corporate loan production increase was multiplied by 2 quarter on quarter. So we do have today a resilience of our SME corporate customers. However, it's true that we can see in our customers a form of uncertainty that they're waiting to see what's going to happen in terms of the macroeconomy worldwide.
Well, let's get straight to our EMEA finance team leader, Tom Metcalf, who's here with me. Tom, always great to speak to you because we can have a full roundup of some of the European banks. Look, Crédit Agricole first. How big of a miss was it?
Yeah, there's certainly, of all the banks reported today, looks like, you know, their shares are taking the biggest beating. And I think that's probably reflecting that while a lot of banks are maybe warning about macro uncertainty, at least in the numbers of Crédit Agricole, you're seeing a little bit of softness in the lending. And, you know, frankly, in this kind of market, if you're missing your estimates, then, you know, you're going to get punished.
So, you know, if you look at BNP Paribas and Soc Gen, they were a little bit more optimistic.
Yeah, broadly speaking, you can, you know, make a case, hey, well, equities trading really strong across those, both those banks. And then BNP is interesting. It seems like the narrative there has been driven by what we just heard from the CFO about, you know, this idea there is macro uncertainty, we're just being very protective. But again, I think people are very sensitive to that, rightly so. And it's interesting to me that BNP Paribas, at least for me, is probably the most high-profile statement of that kind of outlook among some lenders.
Tom, what about Standard Chartered? So actually, you know, profits hit a record and they tried to downplay some of the risks in the Middle East.
Yeah, you can say it's a good set of results for them. I'm sure Bill Winter's pretty happy with how the market's reacted. You know, the biggest thing there, I look at those wealth inflows. That really does sort of seem to suggest that, you know, that push into that business unit is paying off. It's doing well. Of course, like all lenders, they're faced by this, you know, extraordinary geopolitical backdrop. But a bit like UBS, which also obviously has a huge wealth business, it seems that maybe that kind of footprint is better placed or even benefiting from the kind of volatility we're seeing, perhaps with clients looking for sort of, you know, stable places to stash their money.
So is there a danger that actually shareholders expect, you know, this to me feels like a delicate moment for a lot of the banks because of AI, and you don't really know if their business model holds, and they just need to spend more, I guess, on AI, whether internally or they go through another service. But at the same time, are shareholders expecting them to give back in terms of dividends or share buybacks?
Yeah, it's tricky. You look at how much, you know, these firms need to be spending on CapEx, you know, everyone investing in AI. And the question is, what's largely drove their share prices, you know, over the last couple of years was this big share buyback program. Yeah. Obviously, they're not going to pull back on that, but is there any more kind of juice to squeeze from that? And then, of course, it comes, you know, you see these provisions rise, and, you know, does that, again, take away a bit of that sort of capacity to sort of continue to reward shareholders on that front?
And broadly speaking, I mean, the impact, of course, from the conflict in the Middle East, one could be on, you know, households and therefore lending and maybe non-performing loans or something like that, and then trading. Because if you're on the bad side of trading, then it's going to be a problem. Yeah,
exactly. I think whatever your bank footprint is, so in the UK we've got something like a Lloyds or a NatWest, which is very UK-centric. It doesn't matter. Everyone is exposed to Iran because it's going to hit the whole global economy until there's a clear resolution, and, you know, there's going to be a lag, right? You're not seeing it in the first quarter, but I wouldn't be surprised if come second quarter you start to see a few more pain points. And then, yeah, trading, and that is the hardest thing to do in banking, right? Like, make sure you're on the right side of these things, and if you are, suddenly that investment bank, that trading unit is a positive, but when you're on the downside, you know, shareholders really punish you for that.
Tom, thank you so much. As ever, Tom Metcalf there in charge of finance for Europe. Now, coming up, the Mayor of Manchester tells us why he's not ruling out a return to the UK Parliament. Our exclusive interview with Andy Burnham is next, and this is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Burke.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors.
We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Earnings season is here.
Certainly valuations have shifted quite significantly.
Maybe a bit of optimism.
Bloomberg is first to break the numbers.
We're talking about a move away from U.S. assets.
So much corporate issuance.
Let's get the reaction and context.
With the smartest insights.
We're observing what's happening in the Middle East.
The situation is volatile.
We're closely monitoring the impacts on supply chain and logistics.
Cross-border M&A, still such a difficult thing to get done in Europe.
Continuing coverage on Bloomberg.
After my term as chair ends on May 15, I will continue to serve as a governor for a period of time to be determined. I plan to keep a low profile as a governor. There is only ever one chair of the Federal Reserve Board. When Kevin Warsh is confirmed and sworn in, he will be that chair.
Well, that was the Fed Chair, Jay Powell, on staying on as governor when his term ends next month. Now, Japan's top currency official is saying this is my final warning before action. Now, Japan's finance minister is saying they are nearing the time to take bold action on FX. We broke that story at the beginning, of course, of the show. The yen extending some of the losses, dropping some 0.5% to 159.61, and that's a day low. Now, the mayor of Greater Manchester has warned that next week's local elections will be a challenging test for the Prime Minister, Keir Starmer. In an exclusive interview, Andy Burnham, widely tipped as a future successor to the Prime Minister, is calling for a radical change in strategy to restore faith in a fractured political system, as Labour faces a double-edged squeeze from both the left and the right.
Well, they both present a challenge, and you know that's a different challenge in different parts of the country. So Reform stronger in some places, Green Party stronger elsewhere. I'm honest in saying I think we've got to recognise that politics has changed. You know, the two-party system I think is no more, and we've got to start thinking differently about politics. But it's why I've said what we've pioneered in Greater Manchester needs to be what goes national, more collaborative, more place first, not party first, long term, not short term, problem solving, not point scoring. The UK needs a lot of change in politics at the national level.
What does that mean economically? Do you get rid of, do you spend more fiscally? Do you get rid of some of the budget rules?
Well, I think a new politics lays the ground for a new economy, because I think there's long-term work to be done. You know, we need a 10-year approach to repairing public housing, transport, energy, crucially. That affects individual households, but businesses as well. The cost of energy in the UK is far too high. So a 10-year reform programme there. 10-year reform of the care and health system as well. That's what I think the UK needs, and I think it's better done on a collaborative basis, so that Britain is more of an investable proposition. You know, we need to get rid of the turbulence from our politics, because that then doesn't give the markets confidence to invest, and I think we change politics to change the country.
But do you think the budget rules currently are too restrictive?
Well, there's certainly a case when we look at the pressure on defence spending to consider that exceptionally. outside of the rules. But the rules are there for a very important purpose, to give confidence to investors. And obviously the rules will stay in any context. But the world is changing. We all have to accept the need to spend more on security, resilience and defence, and the rules can't stand in the way of that.
Will you try and run for Parliament again this year?
Well, I've tried once this year, and it didn't go so well, or didn't go as I wanted. I actually love my job as the Mayor of Greater Manchester, and I'm kind of really glad to be back here at CityLab, because Michael Bloomberg introduced myself and the Mayor of Liverpool to this network when we left the UK Parliament, and it's really kind of taught us that this is actually the future. But actually, I do think, as I've said in this interview, the politics we've pioneered as mayors, place first, not party first, that needs to go national. And so we do need to reform Westminster. So I'm not going to, I can't remove the kind of feeling that someday I will try and go back.
So you're not ruling it out?
Not ruling it out.
Well, that was the Mayor of Greater Manchester, Andy Burnham. Now, the Bank of England and the European Central Bank are expected to keep rates on hold today. Policymakers playing for time as they assess the economic impact of the war in the Middle East. Now, joining us now is Bloomberg Daybreak anchor Lizzie Burden, and from the ECB in Frankfurt is our Chief Europe correspondent Oliver Crook. So, Ollie, let's start with you. What does the data, or what's the data telling ECB policymakers?
Yeah, so the important thing here for the ECB policymakers is that they set up basically three broad scenarios under which the war in Iran is going to impact the outlook for inflation and also for growth in a number of different sort of areas. There's the baseline, the adverse, and the severe scenarios, the sort of the good, the bad, and the ugly. The good is inflation peaking just over 3%. The kind of middle one is just over 4%, and the bad scenario is over 6%. Now we've been getting GDP data, we've been getting inflation data over the last couple of days from a number of European nations. Overall, the picture has been pretty clear. Inflation is rising, currently segregated just to the energy sector, which is sort of encouraging news for the ECB. But I think what they're very, very concerned about is some of the things we've been seeing out of, say, France, for example, where you see the dynamic in France, which has been very clearly a stagflationary situation, where GDP came in 20 basis points under the expectation, coming in dead flat, whereas inflation came at 2.5%, well above the sort of 20 basis points above the expectation. So that is the kind of dynamic that is really going to worry the ECB. And for the ECB today and the governing council is to try to express to people what kind of inflation they're expecting within the Eurozone and where they are on that spectrum of that scenario from the good, the bad, and the ugly. I think right now we're sort of centered around the bad, but we'll hear from Christine Lagarde in a little while.
Ollie, what can we expect from Lagarde's press conference after today's decision?
Yeah, exactly. So what we're going to be pressing her is the kind of the nature of this inflation. If it is inflation that is sort of segregated into the world of sort of just the energy sector, potentially the ECB can kind of look through that level of inflation for a little bit of period of time. If they start to get the indication that this is reading through to other things, let's say to services, let's say to wages, let's say to food prices, that is something that is going to severely concern the ECB. And the other question for them is the duration. How long is this going to last? And for the European Central Bank, like so many policymakers in the European Union, you're in this situation where you're basically in the driver's seat of a car that you're not controlling. It is being driven right now by Donald Trump. There is no clarity at all on when this energy crisis will end, and it's sort of happening in real time, where you wake up this morning on the day of an ECB rate decision, oil hits $126 a barrel. It's going to be very difficult for the European Union, for the European Central Bank, to give an assessment. I think it'd be a very difficult press conference for Christine Lagarde. I think they know all of the questions that they're going to get later from journalists. I don't know that they have the answers.
Yeah, that's probably right. Lizzie, what should investors be looking for in the BOE's guidance and MPC vote split?
Well, as you suggest, it's not the decision itself that's going to be the exciting part today, Francine. A hold expected, just like at the ECB, only a 10% chance of a hike priced into markets at this point, because it's the same dilemma faced here as in the Eurozone. You've got high inflation, but also subdued economic growth. And that same question, are there going to be second-round effects from the energy price shock? That is what is worrying the chief economist, Hugh Pill. He's likely to be the dissenter in an 8-1 vote split, which is what economists expect we'll get today. Others on the committee are hoping that the weakness in the labour market, excuse the road noise here, will be able to control that feedback loop when it comes to prices. But do watch out for other potential dissenters. Could be Claire Lombardelli, one of the deputy governors, external members, Catherine Mann and Megan Green. And if there are dissenters to the hawkish side, they're likely to really emphasise the adverse scenarios in this first set of forecasts that we get today from the Bank of England since the war started.
And Lizzie, under what conditions would the Bank of England hike rates, and how close are we to that threshold?
Well, it's if we get evidence of those second round effects. And if you look at the latest Bank of England survey data, they actually suggest that you're not seeing that energy price shock fueling wage demands just yet. So most of the MPC likely to want to wait for more evidence to be gathered. At the moment, traders are pricing in 3 hikes before the end of the year. They see them in June, July or September and November. But we'll listen to the governor in his press conference today. How much uncertainty does he want to emphasise around these scenarios? Remember, at the last meeting, well, in March, you had them seeing quite a sharp market reaction in response. Do they stick to that guidance that they stand ready to act? Do they give more hawkish hints on top of that?
Lizzie, thank you so much, Lizzie and Ollie there. Lizzie Burden in London, Oliver Crook in Frankfurt. Now, we'll have, of course, a special coverage of the BOE decision and Governor Andrew Bailey's press conference. That's at midday UK time. A little bit later, we'll also be speaking with Governor Bailey, so you can catch that interview from 4 p.m. Plus, the ECB rate decision, that's at 1:15 p.m. London time, followed by President Lagarde's news conference at 1:45. Now, we also have had a frenzy of big tech earnings. Some key takeaways: Alphabet seeing a clear payoff from its AI spending, while Meta is lagging behind. A couple of other things we're watching out for. Look, pre-market, you can see Amazon is gaining, as is Alphabet. We're seeing a bit of pressure on Meta, down 7.8%, and then Microsoft down 1.8%. Also pre-market. Now, the other big story is definitely Japan. Now, Japan's finance minister has warned about possible intervention in the currency market, saying the timing for taking bold steps is now nearing. So again, the finance minister definitely not mincing her words. The yen jumped after Katayama spoke, trading as strong as 159.81, and that is near a level where authorities intervened in support of Japan's currency on several occasions back in 2024. Again, Katayama saying that ministry officials will be monitoring the currency market even when much of Japan shuts for the prolonged Golden Week holidays that stretch through Wednesday next week, during a period when trading volumes in the markets are expected to be a little bit thin. The other big story, of course, is what's happening with the oil market. Now, Brent oil rallying to a 4-year high after Xauusd reported that the U.S. President Donald Trump will receive a briefing on new military options for actions in Iran. Again, the U.S. and Iran have actually maintained their blockade of the Strait of Hormuz, with the conflict in the Middle East called the biggest supply shock in history by the International Energy Agency. So, plenty more to come on Bloomberg. Up next, it's Bloomberg Brief with Vonnie Quing, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, "Succession starts now."
I'm Francine Lacqua, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacqua.
I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
It's 5 a.m. in New York City, 10 a.m. in London. Good morning, I'm Vonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. A potential escalation in the war with Iran, pushing oil to a 4-year high. The U.S. said to be weighing new military options. Alphabet leading the way with a solid payoff from its AI spending. Meta lagging. Apple is up next. And Treasury steady now after a divided Fed sends the 30-year yield above 5%. PCE and spending data on deck. But it's been fireworks around the world with aggressive verbal intervention out of Japan in the last hour. Let's get over to Tokyo to Alice French for the latest from Asia. Alice.
Good morning. Yes, look, we've had a down day here in Asia with the benchmarks mostly ending lower. I think partly the rise in oil that we saw overnight has not been helping sentiment, particularly also what we had from the Fed yesterday with the dissenters. The Kospi, though, actually closing out April with its strongest monthly performance since 1998. Samsung had some pretty strong earnings this afternoon, but actually ended up lower, I think, partly on concerns around AI spending, which we know is big. And then sticking with Japan here, we've had mixed earnings too, but the yen has really been in focus. We saw it weakening beyond 160 to the dollar yesterday after the Fed decision. That's its weakest since mid-2024. But just here in the past hour, we've had 2 verbal interventions from authorities. We can see it coming back up around that 159 level, but really some worries around aggressive intervention and what we could see potentially in thin trading for the Golden Week period. So people are definitely on high alert.
Yeah, we're going to ask Jordan Rochester his thoughts in just a few minutes about this verbal intervention. But let's get over to Europe now. It's going to be a big day there as well. 2 hours into the European Open. Here's Justina Lee in London. Justina.
Good morning, Vonnie. Here in Europe, we're seeing a 5th straight day of declines for the Stoxx Europe 600 as oil continues to climb higher. Now, speaking of oil, the focus today is all about what the European Central Bank and Bank of England are going to do about those rising inflation expectations. And ahead of those decisions today, we're seeing kind of a pretty flat euro against the dollar, and also the German kind of short end bond yield falling a little bit. Now, we think about the trajectory for the ECB here. They've been on hold for a while, and markets are still expecting a hold decision for today. Same with the Fed, same with the BOE, but all eyes will be what they're projecting ahead, because expectations are for like 3 more rate hikes later this year on the back of those higher oil prices.
Justina, thank you. Justina Lee there. And yes, we saw that a divided Fed yesterday, taking away the easing bias language in some senses, with 3 dissents on that particular issue alone. 4 dissents, obviously, in total, if you include Governor Myron, who will no longer be governor because Fed Chair Jerome Powell is going to take that position now that his Fed chairmanship is up. We finally got clarity on a few agenda items, let's say, yesterday. But central banks around the world obviously grappling with this, and it's not easing today, at least. We had Brent crude trading above above 126 earlier. Now, the June contract is expiring today, but we're seeing it in the July contract and in contracts several months out that this wartime high is being reached today. Is it going to cause secondary price effects? Well, no doubt it is. The 30-year yield just below 5% now. It was above 5% earlier in the session. After the Fed yesterday, we saw those yields rise. But basically, if you look at the 2-year yield, we're up at least 12 basis points now just since Monday alone. Let's take a look at futures because we had some, I don't want to call it mixed earnings. I mean, mostly it was good, but more capex, right? And even that is barely keeping NASDAQ 100 futures in the green. Obviously, investors weighing the potential for AI revenue versus the amount of capex these companies are spending and coming to their own conclusions, all with this war percolating in the background. S&P futures are flat right now, and the dollar index is down more than 0.1%. That yen story, a truly amazing story today. India's rupee is also at a record week mark. All right, let's get to some individual movers now. Over to London again and Chloe Melly. Chloe.
Good morning, Bonnie. Big tech has organized itself very neatly in between winners and losers. On the losing side, we've got Meta and Microsoft falling because of concerns around this AI spending and the pace of growth. And then on the winning side, we've got Alphabet and Amazon, which seem to actually be seeing tangible benefits, a tangible payoff from the AI investment and therefore moving higher. Moving on to another tech story, and Qualcomm is also moving higher today after the chip maker said that it expects to make a lot of progress in the data center market, which will be really a key source of growth going forward, and also said it sees some recovery in the Chinese phone industry. And so we are up more than 10% for that company. And finally, Stellantis is down after investors question the sustainability of its supposed turnaround in North America, because a lot of the performance in that market was actually driven by price cuts and one-time gains as well. And so we're seeing a lot of weakness there, down almost 7%.
Chloe Melly, thank you so much. Chloe there in London. And coming up this hour, more on the Fed and a drumbeat to the BOE and the ECB with Jordan Rochester of Mizuho. And later in the hour, we'll dig into those tech results with Angelo Zeno of CFRA. But first, oil hitting a wartime high with Brent touching above $126 a barrel earlier. President Trump reportedly will be receiving a briefing on new military options for action in Iran. That's according to Axios. Joining us now is Bloomberg's Onur Ant in Dubai. Onur, is there anything to suggest that military action will be any more effective if Trump does decide to take some action again?
I think the reasoning behind the possible military action that is clearly being considered in the US right now at the White House is that it could do the trick in terms of breaking the deadlock. As you know, Hormuz remains shut, and both sides want the other one to reopen or lift their restrictions around the waterway first. And so far, there has been no movement, although the ceasefire is now almost a month or 3 weeks old. So it looks like the Trump administration is considering a possible military operation to sort of break the deadlock and force Iran back into negotiation table. But there is no indication that a renewed fighting would do the trick after weeks of bombing across Iran by US and Israel failed to do so.
Yeah, Onur, if the US does start bombing or, making strikes again, is Iran capable of starting up strikes for its part again? Because that would be considered a breach of the ceasefire.
Well, it would be a breach of ceasefire no matter who started it, and I don't think the Islamic Republic would be reluctant to resume fighting. We have seen that both the US and Israeli attacks on Iran degrade their capabilities to a large extent, but that didn't stop Iran from being able to launch retaliatory attacks, especially on US bases in the Persian Gulf, as well as infrastructure assets in the region, wreaking havoc on energy assets and forcing many OPEC producers to curb their oil output. So there is no reason why Iran wouldn't be able to or wouldn't be willing to restart those attacks in the event of a renewed US military operation against that country.
Onur, we're essentially at a stalemate, right? So Iran responded to the US's proposal with its proposal, and I guess President Trump has decided that its proposal is not workable. So we have two proposals and various people willing to be mediators from Turkey to Russia and everywhere else. But what exactly is the situation? Is there any prospect for any more talks face to face?
Well, it really depends on what happened in Hormuz. That lies at the heart of the current impasse. As you mentioned before, Iran wants the US to lift its naval blockade, and Washington, in turn, wants Iran to stop its blockade first. And neither wants to compromise on who gets to open first. The problem here is that the US does not want just a reopening of Hormuz, but it wants that to be part of a larger peace deal, including Iran's nuclear activities. And that is why this resumption of negotiations, direct negotiations, wherever that may be, is such a tricky situation. And there is no indication since the last round of talks about 3 weeks ago failed in Pakistan that there would be, or there could be, a new round of talks, simply because neither side wants to sort of compromise on their red lines, with that red line on the side of Washington being the issue of nuclear enrichment.
Yeah, and that hasn't budged since the beginning of the war. Owner, thank you so much. Bloomberg's Owner Ant. Big tech results showing clear winners and losers in pre-market trading. Alphabet and Amazon saw more spending pay off, while Meta lagged its peers. Let's bring in the host of Bloomberg Tech Europe, Tom McKenzie. Tom, we were at something like $650 billion in terms of a capex spend forecast, and that's up to something like 725 now. Is that right?
That's right, $725 billion US at the top end on these renewed and revived capex plans from these four big names that reported yesterday. You get the likes of Alphabet committing another $10 billion in terms of spending. You get the Metas of the world as well committing another $10 billion. You put it all together, $725 billion on top of the $640, instead of the $640 billion, to your point, that had been forecast for this year. So just another significant ramp-up in those capex spending plans for these companies. And to some extent, and you touched on this is a tale of two tech companies right now. We can talk about Microsoft and we can talk about Amazon, but really, where you get the real divide, the real distinction, this is a Meta versus Alphabet story. Alphabet being rewarded by investors despite ramping up capex, and that's because it's showing real growth in its cloud unit, where it saw an increase of 20% in terms of revenues year on year. That was a beat in terms of the forecast. They have a backlog. They have a backlog of more than $400 billion US, and in terms of their AI consumer services part of the business, that saw the best quarter on record. So on all of those measures, and that includes the Gemini app, by the way, on all of those measures, Alphabet and Google are firing on all fronts, and so investors are relaxed, in fact, rewarding them for the capex spend. Meta, very different story. What they're seeing there in terms of the traction they're getting through, a little bit of the traction is coming through on the advertising side of the business. Top line, it was actually a beat for Meta, but the ramp-up capex they were putting down to the costs of inputs, the costs of chips, the cost of that data center build-out, and a failure really to articulate clearly from Mark Zuckerberg, the CEO, of course, of Meta, what the end plan is for their AI ambitions and for that spending. Their models still lag at the cutting edge. Yes, they have the advertising business. Yes, they're gearing some of that AI towards advertising revenues, but it's the longer-term strategy around AI coupled with that increase in capex spend that seems to be causing investors in Meta to question what the prospects are in the quarters ahead.
Yeah, and even Mark Zuckerberg saying he doesn't have a very precise plan for how each AI product will be cultivated. So let's move to Apple. What can we expect to see from Apple earnings?
Well, Apple has not committed the spend around AI and the capex spend around AI compared to its counterparts we just talked about, and it lags, frankly, in terms of building out its own AI solutions. It's had to rely largely on Google and on Gemini. So the focus for Apple is going to be on the hardware side, and here is where things are looking pretty bright, particularly in terms of the relatively new product lineup when it comes to the laptops, the Neo laptops. They're really a segment play to try and undermine the cheaper PC laptop market. Some of these laptops are priced at around $500 US. There seems to be a lot of traction there. The question marks for Apple will be to what extent that very sophisticated supply chain they have is resilient to the global shocks that we're seeing, particularly when it comes to memory prices. So anything they say about memory, anything they say about that supply chain resiliency, and if that's holding up, along with that demand picture, of course, not just in the US, but in China, is going to be very significant for Apple as we look to those results later today.
Yes, we will. Bloomberg Tech's Tom McKenzie, thank you so much for that roundup and context. Now to other top stories trending on the terminal this morning. The White House is opposing Anthropic's plan to expand access to its Mythos AI model. According to the Wall Street Journal, officials are worried Anthropic doesn't have the computing power to serve more Mythos users without affecting the government's ability to use it effectively. BNP Paribas lower after disclosing first quarter credit provisions that were higher than estimates. BNP says it set aside $1.1 billion for the quarter. Meantime, net income beat forecasts up 9%. And Glencore shares rising as its traders reap bumper profits from disruption in global commodity markets due to the Iran war. The rise in metals prices boosted its mining business. The rally in copper, zinc and coal helped offset the impact of higher fuel costs. Coming up, we'll be pushing ahead to the BOE and ECB rate decisions with Jordan Rochester of Mizuho Bank. That's next. This is Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Haslida Amin in Davos, Switzerland, and this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
The three dissenters and others who could have supported that, and others who were, who were voters and non-voters who preferred it, they all supported the rate decision, right? So people are not saying we need to hike now. It's more a question of, don't we kind of feel that we should be neutral? And what are markets doing?
A deeper division at the Fed. 3 officials going against the easing bias language amid increased uncertainty fueled by the war in Iran. Joining us now is Jordan Rochester. He is head of FICC strategy for the EMEA region at Mizuho Bank. And Jordan, thank you so much for joining. And we're seeing repercussions across the world today. I think that we can talk about this verbal intervention from the Bank of Japan, really aggressive intervention, as being partially an impact as well of the Fed decision, right?
A little bit. So what you've seen is a triple whammy of factors for why the yen should be weaker during this war. You've got higher oil prices. This is a massive problem for Japan's terms of trade. They are massive energy importers. So that should lead to a weaker yen on its own. You've got higher global yields, especially in Europe and the UK, weighing on the sort of carry trade that usually harms the yen. And then you've also got equities near the record highs. So a triple whammy of good reasons for why the yen should be weaker, yet the market hasn't really chased it as much as what the Japanese or government is suggesting. The models I have, sort of short-term fair valuation models, if you plug all of those inputs in, it suggests that dollar yen should be at 167, and we're not. We've been trading around 158, 159 for several weeks now because of the threat of foreign exchange intervention from the finance minister Katayama and the FX chief Mamura-san, and we're currently just below 160.
Yeah, I mean, Katayama saying literally the timing for taking bold steps is nearing. I mean, the market definitely seemed to listen to that with this weakening, but we're still, in the 159 handle area, right? Is there going to be a time in the next few days where the Bank of Japan will have to intervene?
They've essentially said they're going to. In all of the sort of verbal interventions we've heard over the decades from Japan, this is probably the most strongest. I think Mamura-san said something essentially saying, "You will regret not listening to me." In other words, this is my last warning. So if intervention doesn't follow, if dollar yen goes back above 160, that would be very surprising. And so all we can say is a matter of time and wait. But I would just say for anyone considering trades out there, this is, because of the FX intervention risk, a very low Sharpe ratio trade. If you're trying to sell the yen based on the macro fundamentals like I just talked about, 167 being where we could be trading to, it's just probably not going to get there because the market's reluctant to chase it, because when you get FX intervention, that's 3 to 4% against you usually in the history of interventions on a single day. It's just not a good trade. And so we're going to be hovering around these levels for a while, I think.
Jordan, I want to ask you about the Fed because we have a lot more clarity since yesterday, right? We know that Kevin Warsh is going to be chairman now, and we also know that Fed Chair Jerome Powell is going to move to a governor position, and that there's more unease on the FOMC about the potentially persistent secondary effects of this oil price shock. What does it mean for yields and the US dollar?
Well, I think it's quite interesting timing. His Majesty the King visiting the US, and now the FOMC looks to be more like the Bank of England. You're getting much more dissents on the votes now, thanks to Myron, but also because of these 3 other members arguing there shouldn't be a bias to easing in there. Well, I think what you're going to see with a Warsh Fed is more of the same in terms of this sort of vote split being something that's much more common. The years of unity under Powell, Yellen, and Bernanke are long over, it seems. And I think that it could be the case that when Warsh arrived, you've got Myron and himself pushing the case for rate cuts, but you could see the FOMC regional governors and others arguing the opposite. And so you could have, for the first time, a Fed chair who's outvoted by the rest of the FOMC, first time since 1982 with Volcker.
So what would you be doing in terms of positioning? Because between the war actually ongoing, you know, oil prices skyrocketing, nationally pump prices are at $4.30 yesterday, and in California they actually topped $6. There's real pressure here, and it's getting to be more persistent. Would you be buying bonds, for example, here with yields this high, or are they going to go even higher?
Yeah, absolutely not. I would not be receiving rates here and buying fixed income. But we have to acknowledge that we have sold off quite a lot quite quickly. And the hardest part of this war is not really predicting the ebb and flow of diplomacy between the US and Iran, or the probability of military action. That is hard to predict. The hardest part is the ability of the White House to jawbone the market with essentially false optimism via Axios reports and various others. That could slam the oil market lower with just one headline, as we saw over the past month or so, and that would see rates rally back. So I'm paid rates here. I do think that we could price in the idea of one hike for the Fed by the end of 2027. We're getting close to that idea being in the market pricing now. But I am aware that it all could tumble on one headline. So we have to adjust our positions and trade it from a smaller size.
All right, Jordan, we have to leave it there, but we'll be watching out for the ECB and BOE this morning as well. That is Jordan Rochester of Mizuho Bank, and our thanks. Coming up, Amazon considering a reboot of The Apprentice. A look at what's making headlines in your front page news. This is Bloomberg.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. I'm not here to say what I would and wouldn't do in the future. But the theatrical experience is one that means a great deal to me. It means a great deal to us. Mm-hmm. I feel a certain responsibility. Like if Fruitvale had happened a calendar year later, it probably would have come out on streaming. I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. But that's where I'm at today.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors.
We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Time now for your front page news. First up on the New York Times, Defense Secretary Pete Hegseth's first public appearance on Capitol Hill since the war began. Hegseth castigated members of Congress for questioning the war in Iran, which the Pentagon estimates has cost $25 billion and 14 American lives so far. The hearing came just before a 60-day milestone that some in the GOP have said could become a pivot point for their so far unconditional support of the war. Next up, the Washington Post reporting on the Supreme Court sharply weakening a key provision of the Voting Rights Act. The Post says the ruling limits the consideration of race in drawing voting maps and potentially ushers in Republican gains in the House. And the Wall Street Journal reporting Amazon is discussing a potential reboot of The Apprentice, with executives considering casting Donald Trump Jr. as the host. The Journal says Amazon hasn't approached the Trump family, but its deliberations are part of its push to appeal to conservative supporters and broader audiences. That's your front page headlines, and this is your macro picture as we head into the Thursday session. S&P futures lower, the dollar lower, and the 10-year yield all the way up to 441 after that Fed meeting, and as oil prices just skyrocket. This is Bloomberg.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the US, or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm election.
Hear it first on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
It's 5:30 a.m. in New York City and 10:30 a.m. in London. Good morning. I'm Vonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. A potential escalation in the war with Iran, pushing oil to a 4-year high. The U.S. said to be weighing new military options. Alphabet leading the way with a solid payoff from its AI spending. Meta lagging. Apple is up next. And Treasury is now steady after a divided Fed sent the 30-year yield above 5%. PCE and spending data are on deck. Let's take a look at these markets, because look at Brent crude. Now, that is the current contract and it is expiring today, but it's above 118. We got to 126 and change earlier. WTI above $107 a barrel. And this all as the war continues and President Trump may be weighing more military options. We also had that hawkish hold at the Fed. 3 dissents over language that points to future cuts. And then this morning we had aggressive verbal intervention in Japan. Asian currencies really feeling the pain from these oil prices at records. Look at the 30-year yield. It topped 5% earlier. If we take a look at futures, even with mostly fine earnings yesterday, we're seeing futures just barely in the green. The S&P and NASDAQ 100 futures now pointing to higher opens. Earlier, the S&P was looking to open lower. The dollar index down about 0.2%. Asian currencies really across the board are weaker today. We saw the yen top 160, and both finance minister and the currency chief come out with aggressive verbal intervention. Let's get to some individual movers now with Chloe Melly in London. Chloe.
Good morning, Vonnie. It's a tale of winners and losers in big tech this morning. We're seeing Microsoft, but in particular Meta, falling because of those growing concerns over AI spending, while on the other hand, we're seeing Alphabet and Amazon move higher because it seems that their AI investments are actually paying off with some tangible benefits. Moving on to another name in that tech sector, which is the chip maker Qualcomm, which is moving higher, up more than 11% this morning after saying it is making inroads in the data center market that will become a key source of growth going forward, and it's also benefiting from a recovery in the phone industry in China, and so we are up quite strongly there. And finally, Stellantis is down after investors question the sustainability of this expected turnaround in the very important North American market, because the performance in that market was driven primarily by price cuts and by one-time gains from tariff refunds as well. So there are some questions there, and therefore we are down quite a bit, down almost 7% for Stellantis this morning.
All right, Chloe, thank you so much. Last trading day in April, and here's where we are. That's Chloe Melly. Let's get to Washington now, where President Trump is set to receive a briefing on new military options for action in Iran. That's according to Axios. The report sending oil to a wartime high. Brent crude currently trading just below 117, coming off just a little bit, that contract expiring today. Bloomberg Kasia Klimashinska joins us now. So what's the word in Washington, Kasia? What kind of military options does the president have? And, you know, is there anybody saying that this might actually bring Iran back to any kind of negotiating table?
Vonnie, hello. So the bottom line is that this ceasefire between the U.S. and Iran is now at risk because President Trump, according to Axios, is going to get a briefing today outlining some potential military options, one of which would be a brief but powerful attack that the U.S. would be hoping that it would bring Iran back to the table to discuss its nuclear enrichment plans. But there are also other possibilities that President Trump might look at today. One of them would be an attempt to reopen at least part of this key waterway, Strait of Hormuz. And finally, another one, a special operation in which the U.S. would try to get a hold of Iran's nuclear stockpile. So this is the briefing that the U.S. Central Command Admiral Brad Cooper will bring to Trump today. He did talk to President before in the last days of February, and some sources told Axios that that briefing encouraged Trump back then to go ahead with the military operation. So that's perhaps why we see those dramatic movements, especially in the oil market today, out of concern that we will see more military action in the Middle East, not only from the U.S., but perhaps also from Iran retaliating.
Right, and no clear strategy really to bring Iran back to the table either. It's not clear that more force rather than persuasion will do anything other than further entrench Iran. Now, moving to domestic issues, it seems like the DHS shutdown is nearing its end. Bring us up to speed on this.
So that's after 75 days of shutdown of the Department of Homeland Security. That's the department that is enforcing immigration, anti-immigration policies of the Trump administration, but also is responsible for verifying the safety of our luggage at the airports. So finally here we see some movement. Republicans in the House have passed part of the plan that would finance the department yesterday, and they are likely to act again today. It's mostly just Republicans because, remember, 75 days ago, Democrats said that they won't fund the department anymore after the tragic violence in Minnesota that led to shooting of 2 Americans there.
All right, Kasia, thank you so much. That is Bloomberg's Kasia Klimashinska. Turning to markets now, a lot to digest today. Treasuries a little steadier after a slump driven by the Fed's hawkish hold and anticipation of that, I should say. 30-year yields now back just below 5%, having topped that level a little earlier. Joining us is Bloomberg's Ven Ram. So, Ven, has the market repriced? Is that the move over at this point, repricing for an FOMC that's maybe a little more concerned about persistent inflation?
Well, I think that, the path of least resistance for rates is definitely higher from here. Because, as you mentioned, there was this dissent, massive dissent within the Fed, within the FOMC. And I think that, the Fed has projected a core PC of 2.7% for this year. We can almost disappear, we can almost banish any thoughts of inflation dissipating at any point soon to 2.7%. I think that we are going to get a much higher read on inflation in the coming months thanks to the energy shock. So I think that, the markets are still not pricing a hawkish Fed, because if you look at the VERP action, if you look at the action on SOFR rates, I think it's a pretty flat curve still. So I think that, the markets are underpricing the risk that the Fed may have to increase rates. But, it's clear why the markets are positioning the way they are because of Warsh's previous pronouncement that the interest rates can go lower with the new paradigm. But I don't know how he could do that, particularly considering the dissent. So I think that the path for rates is higher from here.
Yeah, the Warsh impact may be cushioning the blow a little bit, as you say, at least for now. Let's move to the Bank of England and the ECB, because we're going to get, rate decisions there too, and they're also grappling with the same issues, Ven. I mean, what happens to currencies when those decisions come out if they don't sound any more united than the Fed?
Well, I think that the Bank of England has got an imperative to act because, they've been missing inflation. They're missing the inflation target for the better part of 5 years now. So the markets have already punished gilts severely this year. And I think that if the Bank of England says that there is no urgency to act, I think that the markets will punish the Bank of England by sending rates higher. That may be ironically supportive of the pound for the time being. And in the case of ECB, Vonnie, I think that, although the ECB has said that they won't hesitate to act, the markets are most keen to hear when the first rate hike will come. And if they say that, they're willing to raise rates as soon as in June, because given the oil price spiral and it's already close to their adverse scenario. So I think that if they suggest that, I think that the markets will get slightly calmer, ironically, because, it shows that they are willing to stamp out second-round inflation.
Yeah, and then, it took some time, but the Japanese authorities finally came out with the big bazooka, if you like, of verbal intervention, at least today, right, Ven? Because we saw the yen above 160 for several hours. Will this work? We're trading now at, 159 and change, but that's, still pretty weak.
Exactly, as you said, Bonnie, 159 and change is exactly what it is. So what it shows is that the yen hasn't moved that much despite the jawboning. And the markets, frankly, have grown inured to the idea of jawboning from the Bank of Japan and Japanese currency officials because, they've been saying it for months now without actually following through on their actions. But even if they do act, I think that the upside for the yen is very tactical. It'll be about 3 to 4%, maybe 5% on a good day. So I think that's as much as you can expect. But the question is how long any gains in the yen will be sustainable. And that's not going to be sustainable simply because the Bank of Japan is behind the curve. It was already behind the curve before the war, and it is even more so now after the war because of the likely inflation overshoot. And of course, the BOJ themselves raised the inflation forecast for this year, next year. So I think that if they continue to drag their feet on raising rates, the markets will punish the JGBs, and that will mean higher yields, and that will also mean a weaker yen. There is no escaping the longer-term trajectory of the yen if the BOJ hesitates to act. It doesn't matter what the currency official says. It's what the BOJ does that matters for the currency.
All right, we'll see what the BOJ does next. Ven, thank you so much, Bloomberg's Ven Ram. And don't miss our interview with National Economic Council Director Kevin Hassett. That's at 9:30 a.m. New York time. Now to other top stories trending on the terminal this morning. The White House is opposing Anthropic's plan to expand access to its Mythos AI model. According to the Wall Street Journal, officials are worried Anthropic doesn't have the computing power to serve more Mythos users without affecting the government's ability to use it effectively. Saudi Arabia's Public Investment Fund plans to stop financial support for Live Golf after this season. An announcement is scheduled today that will detail Live Golf's next business steps. Live declined to comment. The demise of Live would leave the players who left the PGA Tour in a state of professional limbo. Bill Ackman's Pershing Square USA down 18% in its IPO debut. The combined closed-end fund and alternative asset manager raised $5 billion, short of the high end of $25 billion it was aiming for 2 years ago. Coming up, we'll dig into the report cards on AI spending with Angelo Zeno of CFRA next. This is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Power Players is back to take a look under the hood of the business of Formula One.
Hi, I'm here to see Pierre Gasly.
Welcome to my workplace.
Do you feel pressure?
Massive pressure.
Ferrari is the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard.
Oh boy.
Can you imagine Ferrari without racing?
No, and I say no, no, no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days ago.
I can't even believe that. And the speed of the business has never moved faster.
My career might stop, but I'll still be driving some.
Yeah.
Probably very fast.
Yeah.
This is so exciting!
This season, we're along for the ride.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
The coding models have gotten so good that they are now contributing in a significant way to the rate of improvement of AI itself. And so the AI is really good, and it's getting better as a result of the quality of AI. And so kind of recursive self-improvement is this industry term here.
John Collison there, the president of mobile payment provider Stripe, on its AI strategy. So return on the AI spending speed front and centre this earnings season. Alphabet a clear winner with a solid payoff. Meta, though, lagging, and you can see it in the pre-market moves. Let's bring in Angelo Zeno of CFRA, who's running on just a couple of hours sleep, I think, Angelo. Talk to us a little bit about the hyperscalers. We've got this massive amount of new spending, and we weren't really expecting it this quarter, were we?
No, I mean, not necessarily. I'd say it did play out largely how we thought, in the sense that you look at both Alphabet and Meta, they just really just tweaked the numbers higher. I mean, Alphabet went to 190 billion at the high end. They were looking at 185 billion previously. And then when you look at Meta, I think they boosted the high end by about 10 billion to 145 billion. So, you know, in our view, those are very modest increases, but I think very good the fact that they held those CapEx numbers and outlook for the year. And then on the Microsoft side of things, that was, you know, if there was one company that was going to significantly ratchet the numbers, it was going to be Microsoft, and that's exactly what they did, alluding to 190 billion. They did basically cite, you know, the supply constraints that are out there, which is probably also the reason the other two tweaked the numbers also higher. But at the end of the day, when you look at the trajectory of these three companies, I'd say largely kind of how we expected it to play out.
Yeah, I mean, it is interesting, though. Mark Zuckerberg really wasn't apologetic at all. In fact, he admitted that Meta doesn't have a very precise plan for how each AI product will be cultivated. Investors aren't taking it this morning, Angelo. Will they in general?
Yeah, I mean, I think as far as Meta is concerned, that was the one that had the most to prove going into this quarter. And, you know, I'd also say they probably did the least, you know, they served themselves the least in terms of the trajectory that they threw out there in terms of, you know, talking the AI story and monetization efforts. They didn't really give, I think, as many details about the potential ramp up in products that you can see in the monetization of those, you know, new LLMs and what have you over the next couple of quarters. So I think, you know, the negative reaction you're seeing in shares here this morning largely reflects that, as well as the need to continue to spend aggressively. I think investors really want, you know, a strong story and greater direction on how that AI spend is going to be monetized. And Zuckerberg just didn't do that in the fall.
Is getting data centers online going to be a huge problem, Angelo? I mean, some of this increase in capex was because of, you know, component costs going up because of the Iran war and so on. It wasn't just new spending, let's say. But it does seem like there could be more of a block, let's say, to getting data centers online. And how much will that present problems going forward?
No, I think that's a fair point. And, you know, when we start thinking about data centers and data center installations going online, especially amid the higher expected CapEx spend, and not to mention as you go into 2027, I mean, we just heard Alphabet talk about sharply higher spend in 27. Again, the higher spend is justified in the sense that the demand is there. I think the issue is going to be is we are just running extremely tight across the supply chain, whether it be memory, whether it be CPUs, whether it be on the optics side of things. There are so many bottlenecks across the supply chain, and that doesn't even go into taking into account the energy concerns and need to find, you know, the energy to kind of run these data centers. properly, which we think is going to be more of an issue by late 2027 into 2028. So there are concerns as far as getting these data centers connected and getting all that supply on in your hands. But that being said, at least over the next 2-3 quarters, at this point in time, we think most of these hyperscalers, they've got a good grasp on things.
Just in terms of each company's fundamentals, there's a broad spectrum, right? Are some of them more exposed to problems emanating from higher oil prices, persistent inflation potentially, and just the Iran war in general? Or, are others of them better able to hold up with these weaker macro fundamentals?
Yeah, no, it's a good question. So I think as far as Alphabet is concerned, they're probably best positioned right now just because of the backlog. I mean, they essentially talked about a nearly doubling of their backlog on the cloud side, quarter over quarter. The demand visibility is there for this company, not to mention what they're doing on the search side of things. Even with macro uncertainties out there, search is usually the last thing to get cut on the advertising side of things because of what they offer to advertisers. I would say, and the ROI there, I would say in terms of the risk, that the name getting hit right now in terms of Meta is the name that you would have to acknowledge is more prone to some of the macro uncertainties, some of the Middle East uncertainties. They cited it on the call as well in terms of missing their daily active user numbers. So that would be the one most at risk. I think Microsoft really did a good job in terms of talking up their story on the call. Obviously, it's not being rewarded here pre-market, but nonetheless, in terms of what they've done with Copilot and their cloud business, I think overall they're executing extremely well. But that's something else. That's another name you do have to watch out for in terms of where budgets go amid macro uncertainties.
Absolutely, Angelo. The hard part's done. Thank you so much, Angelo Zeno of CFRA. Staying with earnings and consumer names, including Hershey's and Molson Coors, reporting before the bell. Bloomberg's Jennifer Creary joins us now for more. Jennifer, we're just beginning to hear in earnings calls things about the Iran war and higher oil prices and how they're impacting business, essentially. What will we expect to hear today about the consumer?
Yeah, listen, I mean, with a lot of these companies are highlighting the impact of conflict in the Middle East on consumer sentiment, but also energy pricing. That's really eating into the amount of costs that these businesses can swallow. So on the consumer front, it seems like a fairly mixed bag. So we've got Hershey's on the one hand, the chocolate maker, expected to post fairly positive results. Analysts are citing an early Easter as giving them a bit of a boost in Q1. Now, Hershey's only recently, earlier this month, said that it expects organic net sales to grow 2 to 4% every year through to 2028 and beyond. So it's fairly bullish, but of course, investors will be looking out for further commentary on whether conflict in the Middle East or other macro factors will be affecting its outlook going forward. We've also got Wayfair, the home furnishings provider. Much of its growth is expected to come from overseas rather than the US. The US has really suffered from slow app downloads, but also weaker consumer sentiment. And on the other hand, there's also Molson Coors, the beer maker, expected to post another quarter of volume declines. Now, Molson Coors, it's not a great time to be a beer maker at the moment. Consumers are really pulling back on their drinking. But, it's made a couple of acquisitions as of late. Atomic Brands, for example, the cocktail provider. Molson Coors essentially trying to diversify some of its holdings. So companies are trying to spread some of that risk across its portfolio.
Jennifer, we'll hear what they all have to say on the calls. And we'll also get some travel companies, too, to give us some insight, like Hyatt and Royal Caribbean. That's Bloomberg's Jennifer Creary. Coming up, rate decisions from the Bank of England and European Central Bank will get you set up for your trading day. This is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersecci in Davos, Switzerland, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Middle East tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Now a look at what's ahead today, the final trading day of April. More earnings, of course. We have Hershey, Caterpillar, Eli Lilly, all before the bell, and then Apple, the big one after the bell. Also, rate decisions from the Bank of England in just more than an hour, and then the ECB at 8:15 a.m. Eastern. Plus, we get plenty of data today as well. US PCE at 8:30 a.m. Eastern, along with GDP data, personal income and spending, and jobless claims. Let's take a look at some movers pre-market. There are going to be a lot of very volatile stocks trading today. Alphabet extending post-earnings gains this morning after a strong return on AI spending really cheered Alphabet investors. A whole different story for Meta. Its spending plan offsetting solid results. Also, Mark Zuckerberg's unapologetic tone on the call. Qualcomm, another winner, up more than 10% in the pre-market from yesterday's slew of earnings after the firm said it's making headway in the data center market. And then this is your macro outlook for the day. It could be a tough one. April not going out like a lamb at all. Brent crude is lower now, but it topped $126 a barrel earlier. We have S&P futures barely higher, and the 10-year yield down 3 basis points after a phenomenal move this week. That's it for Bloomberg Brief.
The quarterfinals at the Mutua Madrid Open. Yannick Sinner ended local hero Rafael Hodar's dream run with a comfortable straight sets win to reach the semi-finals. The world number one continuing his excellent run of recent form, which included winning the Sunshine Double at Indian Wells and Miami. And don't forget, you can watch all the action live daily and head on over to tennischannel.com to download the app.
AI, some people would say that there's maybe a little bit of a bubble in AI. When you have companies with market caps of $5 trillion, you don't see any bubble there at all?
Whenever we have an acceleration in technology and people get excited about it, you have significant capital formation around new companies that are trying to capitalize on that opportunity. And, we've seen this before through history. and you're seeing it now. It won't be a straight line. The opportunity set with AI is enormous. There will be winners and losers, and it's hard to pick the winners and losers now. And certainly, a lot of the capital that's being deployed will not produce adequate returns, and a bunch of the capital that's being deployed will actually not produce any returns. But it's hard, it's hard to call the timing on these things. And the thing I'd point to, just from a historical lens, is in the fall of 1996, Alan Greenspan talked about irrational exuberance in stock markets, and the NASDAQ was at 1,300. And the NASDAQ peaked 3.5 years later at over 5,000. So, these things can go on for a long time, but ultimately, there are adjustments, there will be drawdowns, there'll be rebalancing, and just, it's hard to call it because the technology trend and the investment is real.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
Insight with Haslinda Amin, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
It's all about the tech sector within the equity market.
We might be a little bit overbought here.
You have very strong sort of earnings fundamentals underpinning things.
Everyone is looking to make sure that this growth is still as strong as it has been.
The outlook still is optimistic.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, division grows. A divided Federal Reserve just about holding on to an easing bias as failure to find a diplomatic solution with Iran is keeping crude elevated. Performance of some of the world's biggest companies beginning to splinter. Meta slides, Alphabet climbs.
Let's just put this into perspective. $725 billion. That is how much the four hyperscalers that announced earnings after the bell, the three with Meta, announced after the earnings for this particular year for CapEx. How much is this justified? And that's where the splintering comes into play. For Alphabet, they're crushing it in terms of the acceleration of their revenues. People say, great. For Meta, it's increasing because component costs are increasing. And what they're going to do with it, trust us, not exactly flying in markets right now.
Will this tech story keep this equity market supported with this developing in the commodity market? This from Axios this morning. And for once, the Axios story is not bullish. President Trump slated to receive a briefing on new plans for potential military action in Iran. Wartime highs on crude just off those levels this morning. Brent pulling back from 120. Brent this morning around 160.
So we really need to understand what options are going to be presented to the president and then what decision he makes. At the moment, what we've seen from this president is he's willing to keep the blockade, have this impasse, no need to escalate, no need to de-escalate. If leverage is what the Iranians hold in the Strait of Hormuz, potentially that is what the president could decide when it comes to an escalation. Maybe not striking targets in Iran, but maybe the Navy has to come through and start escorting tankers through, because can they live with these oil prices? Look at where gasoline is this morning in California, north of $6 a gallon.
Do we get some soothing words as we get closer to the opening bell? Maybe, but bear in mind this. April 17th, the president came out and said the Strait of Hormuz was reopening. Over the weekend, it didn't. Ever since, we have not had a down day for crude. Ever since then. This market has really snapped into show-me mode. The hopium no longer bites in quite the same way.
Exactly. Verbal intervention doesn't hold the same kind of punch. And right now, this is coming at a time where economies are not yet breaking. So you've got fiscal and corporate stimulus, if you will. At the same time, the oil prices are going higher. And suddenly, we're talking about a new kind of tightening of financial conditions, a 40% chance of a rate hike by next March by the Federal Reserve. All of this comes together with this real tension. How long can risk assets keep rallying?
Let's go through some of the levels we're at this morning in the bond market. Country to country, starting with the US, near the highs of the year on a 10-year yield. In Germany, back to the 2011 highs. In the UK, numbers we haven't seen since around 2008. Over in Japan, the 1990s. We're back to March again. We're hitting those kind of levels once more.
We're above 2.5% in Japan. Just a couple of years ago, we were at zero. The idea of 2.5% in Japan is like getting 10% in a lot of other places, considering that they own the bond market, and this has not been a market for a very long time. Does this reset expectations? And again, I go back to what is the exit strategy? If we have higher oil prices, but we don't have an economy that is torpedoing, and if anything, governments are saying, we'll support you, consumer, because politically it is going to be disastrous for us not to do this. That is why you're getting a real hesitance from buyers of the long end, exactly what levels they're going to accept.
And now Japan's finance ministry threatening to intervene in the FX market because of the moves we've seen in the Japanese yen. Later this morning, programme note for you, 9:30 Eastern Time. We'll extend the programme. We'll bring you the news conference with Christine Lagarde over at the ECB. After that, we'll catch up with this guy right here, the NEC director, Kevin Hassett, following quite the announcement from the chairman of the Federal Reserve just yesterday in the news conference. He's stepping aside for Kevin Walsh, but, and it's a big but, he's sticking around. He's staying on the board.
He wants to see the process concluded with full transparency, the process of legal challenges. And he said that that has been an attack on the institution of the Federal Reserve. I'm sure there'll be some harsh words. We heard from Treasury Secretary Scott Bessent yesterday talking about how this was an insult with respect to his staying on. A real question about what the administration's response is going to be.
Well, Jay Powell yesterday, and great job, guys. I watched the whole Fed programming. He said he's going to keep a low profile, but at the same time, he had this stature of Fed chair. So how do you keep a low profile? We didn't just hear from the Treasury Secretary. We also heard from the President of the United States. A brief truth for the president, but he said he wants to stay at the Fed because he can't get a job anywhere else.
I thought that was a lightweight truth. A lightweight social media post.
I
thought
also
it was
think
nothing
it's false.
compared to what I was expecting to see from the president after that announcement yesterday. I didn't think that was much at all.
To me, that was almost an endorsement of his staying on. I mean, not you're fired. This is war. We're going to, we're going to go to the straight and hash this out. I mean, truly, that's the kind of stuff I was expecting.
That was pretty tame stuff. Yield to lower this morning by 3 basis points. 10's around 4.40. Coming up this hour, we'll catch up with Julian Emmanuel of Evercore, with markets whipsawed by earnings. Victoria Coates of the Heritage Foundation as the US-Iran standoff sends crude surging. And Neil Dutta of Renmac with Fed Chair Jay Powell passing the torch, kinda. We begin this hour with stocks wavering after crude surged and mixed tech earnings are failing to spark a rally. Julian Emmanuel of Evercore writing, the base case remains the tech-led bull to 77.50. The independence of stocks and the economy from malign triple-digit crude will not be sustainable. Julian joins us now for more. Julian, good morning.
Good morning.
Good to see you, sir. Are we reaching a tipping point?
Well, what you just put up is kind of a contradictory statement. We think that the bull market is predicated on, number one, earnings, which have been off the charts, absolutely off the charts. But you are at this point where the malign effects of oil will not be ignored if this goes on much longer.
Well, let's go with the last 24 hours. What do you believe is more consequential, the move in crude, the earnings we got, or what we heard and saw from the Federal Reserve?
Yes, all of them.
You can't pick one, all three.
Well, I would have to say that earnings, look, again, and we've been very adamant about it. We've been adamant throughout the entirety of this 3.5-year bull market run, is that if you look at a multi-decade chart, earnings and stock prices have a very, very close correlation. And it is no surprise, if you think back 30 days ago, where we were, in the depths, despair, but yet you're still in an environment where the market has ripped higher, as crude has ripped higher, as yields, as you pointed out, have ripped higher. Why? Because earnings are ripping higher.
This is the big question. Lisa talked about the bond market. Yields are back to where they were, and through those levels in some cases, at the end of March. Anne-Marie went for the reasons that we've got through crude back to wartime highs, at least briefly, in the last 24 hours. All of those stories have gone back to the end of March, with the exception of equities, which have had a move of 13% off the lows of March. Do you really believe that story is insulated because of earnings from what's happening elsewhere in other asset classes?
In the medium term, it cannot be. In the near term, it is, again, because going back to the call we made at the end of last month, is that the hedging that we had seen in the markets was unlike anything that we had seen over the last 30-plus years of doing this. And so almost by default, unless the world was ending in that moment, you were going to get the degree of rally which you got, which by a lot of measures was as strong as what started this generational bull market in August of 1982. But again, just going back to where the situation is, there's an optionality component here to at some point triple-digit oil is going to cause the economy to slow and is going to cause earnings to slow with it. We just, our work has said the 4-month window is really, really sort of the time looking at past spikes. Where that comes into play, we're getting close.
Except for tech, because ultimately that's what everyone's been saying, except for AI spending. And that would be the one thing that ultimately keeps going, because ultimately, as my son told me last night, AI beats humans, and we can all just rely on our chatbots more than we can our mothers.
You had a good evening.
I was fantastic. I'm really existential this morning. Please watch out. But I am curious about, from your perspective, at what point is this CapEx plan unsustainable if it's just to pay for higher and higher commodity costs that are the inputs to what they're trying to build?
Well, that is a challenge, disaggregating, and that's why, one of the companies that reported last night is softer, because you can't disaggregate, what is higher input costs and what is, organically higher CapEx intentions, and that is, an issue. But look, again, all of this is predicated on the fact that you can have a continuation of this build-out provided two things. Number one, that conditions in the economy and the credit markets remain benign, which they clearly are, despite triple-digit oil right now, and this idea that there is an eventual payback window for the AI build-out. And again, the evidence is that there is adoption going on. The evidence is that it is driving revenues and it is saving costs. Is it as fast as the market would have expected it to be? No. But because the economy is as benign as it is away from oil, there is patience.
So I want to come up with another expression than boiling the frog, because Pete is coming after me. But I'm curious also about at what point you hit a tipping point, in terms of you have CapEx that keeps increasing because it feels existential and independent. You have yields that are going up because people can keep spending, which allows inflation to keep going through the system. You have enough resilience to keep those yields high. At what point do the yields become the breaker to this entire cycle?
Well, and that's why this is a challenging environment, because as we've seen over the last several months, yields are moving higher in lockstep with the price of crude oil. And so that it really points to the fact that this is a time optionality to all of this. My answer to that would be is that, until the economy shows signs of cracking, this is sustainable, okay? There are no signs of cracking right now. Remember, a couple months ago, we had credit angst all swept aside. It was an issue that we know now has been contained. But essentially, what you're looking for is signs of stress, and there aren't any at the moment.
How many months can we live with triple-digit crude?
Our work has shown that sort of month 4 is where things get dicey. Again, it's also the amplitude. In our mind, if you break the prior March, the beginning of the cycle high, around 120 on WTI in a material way, that will accelerate the timeline. But otherwise, we're looking at sort of Independence Day. July 4th is kind of a line in the sand.
It's $99 in the futures curve for July. That's triple digits, basically.
It is. You are essentially at that, which is why it's incumbent for the prices to find a way, whatever that way is, to moderate between now and then.
Julian, it's good to see you're going to stick with us, I'm pleased to say, to break down some of these tech earnings just a little bit more. Julian Emmanuel there of Evercore. For your equity market this morning, and good morning to you, just about positive by 0.2% on the S&P. With an update on stories worldwide with your Bloomberg Brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, good morning, John. President Trump defending the U.S. blockade of Iranian ports, saying it's more effective than bombing the country. Trump rejecting the latest Iranian proposal to open the Strait of Hormuz and lift the blockade until concerns about its nuclear program are addressed. Axios reporting the president will receive a new briefing on the situation today. Max 7 earnings in full swing. Shares of Alphabet are rising after the tech giant reported solid growth at its cloud computing unit. Amazon also beating on key metrics. Meta, though, falling after issuing a capex forecast that was higher than investors expected. The Federal Reserve holding rates steady in Jay Powell's final rate decision as chair. 4 policymakers dissenting against the decision, with 3 opposing in particular, the language suggesting the Fed will eventually resume rate cuts. One, Governor Stephen Miron, preferring a quarter-point rate cut this time. And that is your Bloomberg Brief. John.
Ivani, thank you. Good to have you. More Vonnie Quinn a little bit later this hour. Up next on the programme, wrapping up a monster day of tech earnings.
The 3 critical data center businesses, the hyperscaler businesses, exceeded expectations. They're all still accelerating. Meta's not even in the top 10, I would say, in terms of its frontier model.
We'll talk more about Meta in just a moment. Stefan Slavinsky of BNP Paribas joins us next, live from New York City this morning. Good morning.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Coming up a little bit later, 2 central bank decisions, 7 a.m. Eastern Time. We'll hear from the Bank of England. Later at 8:15, we'll hear from the ECB. Then we've got economic data at 8:30 Eastern Time. Jobless claims and a whole lot more. Then after the close, the other big tech titan, Apple reporting after the close a little bit later.
Does it matter? I guess this is the real question. How much does the backward-looking data for Apple matter, and how much is it going to be the show of who's taking over and what they're planning to do? Is there going to be some sort of CapEx plan that's going to be announced to talk about exactly how they're going to bring AI into the iPhone?
You brought up the really important question for Meta. Meta's increased CapEx. Are they doing that because there's more things to buy? Or the things to buy just got more expensive?
We don't know. And ultimately, we heard this tone also from Microsoft. Others also increased their CapEx plan, partly because the cost is just going up, and we've heard this from everyone. So at what point are they actually getting more for their increased costs, or are they just simply having to pay more? And is that something that's digestible for people? AI at what cost?
Nasdaq futures this morning positive by 0.2% on the S&P 500, up a little more than 0.1%. Under surveillance this morning, wrapping up a monster day of tech earnings.
The 3 critical data center businesses, the hyperscaler businesses, exceeded expectations. They're all still accelerating. That's a very good sign in terms of the progress of AI. Meta's not even in the top 10, I would say, in terms of its frontier model. Investors are going to expect them to either calm down on the CapEx or reduce enough OpEx to allow margins not to be degraded.
So here's the latest this morning. Big tech earnings kicking off with Alphabet surging on high demand for its cloud and AI platforms, while Meta's capex forecast is fueling investor doubts. Joining us now to discuss is Stefan Slavitsky of BNP Paribas Xauusd. Stefan, welcome to the program. I want to talk about Meta exclusively. Just first off, they've raised their capex. Lisa and I were just talking about it. Are they doing that because there's more things to buy, or the things they wanted to buy just got more expensive?
Yeah, good morning. I think it's mostly inflation. So you see Meta raising capex by 10 billion and talking about the component price inflation. Microsoft talking about close to 200 billion of capex this calendar year, and they're highlighting that 25 billion of that is just coming from that component price inflation. So I think that is one of the flies in the ointment today. Those were 4 great set of numbers yesterday, especially on the top line, but also margins expanding for all 4 by 125 basis points on average. But capex keeps going up, and increasingly that's being driven by inflation.
And some companies are being punished for it, others aren't. Meta's being punished for it. It's down by 8% in the pre-market. Do you think, Stefan, that's something they just continue to stomach?
I think when you look at the reactions today, what you're seeing from Google and Amazon is they're chip companies now. And so one of the big trades of the past year and the past 3 years has really been hardware over software. And so when you look at Amazon, when you look at Google and their proprietary semiconductors, Inferentia and Trainium, they're going to be increasingly selling those to enterprises and to third parties. So they're in a way a beneficiary of that. Microsoft and Meta are behind on their proprietary silicon, and so they have to stomach those costs a bit more than the other two.
How much, Stefan, do we see the market starting to say, we're going to go with the promises of Amazon and Alphabet, because they do go beyond just the chip production, obviously, and they're direct competitors with Microsoft in particular. Is Microsoft truly falling behind?
I think when you look at the results last night for Microsoft, Amazon, Google, the big hyperscalers, they did all see growth accelerate in the quarter. Interestingly, when you look at the quarter, Google added the most incremental revenue, even more than Amazon and Microsoft. So they're officially kind of neck and neck now with the big two. But what I think you're also seeing is not only are all 3 of them benefiting from enterprise cloud demand, but their core businesses are benefiting as well. So Google search going from 17 to 19% growth. It was 10% just a year ago. Microsoft, the big concern was Microsoft 365 commercial cloud, the kind of office business that would be disrupted by Anthropic, but growth actually accelerated to 15%, and we're seeing Copilot demand finally boom. And even Amazon's core business is still doing low double-digit growth. So that's reassuring for all of them that they're monetizing AI, not just in enterprise cloud demand, but in their core businesses. And finally, I think the other thing that's really positive is it's not just renting out GPU infrastructure to model companies. We're starting to see that cloud monetization broaden out to other products, especially software products, databases, data platforms. And that's important because those are higher margin businesses. That's what drove high margins in Cloud 1.0. And the companies are increasingly saying they're seeing signs that that will help drive returns in Cloud 2.0 in this GPU cloud build out.
Stefan, how long before CapEx becomes a nice to have versus a need to have?
Well, right now it's still a need to have. As you pointed out, we were at probably 725 billion now between the big 4 and CapEx this year. Last night, Google said next year, 27 will be up significantly or meaningfully. So we're going to blow through $1 trillion probably next year. Thankfully, we are seeing the uses increase. Thankfully, we are seeing the monetization. But as we're seeing in Microsoft a bit today, and certainly Meta, if you don't have a clear path to monetizing that CapEx via multiple routes, via new AI businesses, via your core business, maybe via hardware and other capabilities, the market's going to increasingly scrutinize that CapEx spend, even if your core business is doing very well, as it is in Meta's case, growing 33%.
Stefan, it's good to see you. Thank you, sir. Meta down by close to 9%. The story of Alphabet, the turnaround there in the last 12 months, absolutely phenomenal. Meaningful acceleration of growth, crushing guesstimates. CapEx, $185 billion for this year. That's double last year. The turnaround here. Imagine me saying to you last year when people thought they were in some kind of existential moment, they'd come out with numbers like this. 12 months later.
Yeah, and they're winning on search. They're beating, actually, ChatGPT. They're beating the OpenAI product in a material way and saying not only does it not replace search, it enhances it and brings more viewers in. Their earnings per share was $5.11 versus the estimate of $2.62. That gives you a sense of the scope of this beat.
Gillian, still with us. Gillian, let's go through some of these numbers, these results. Things can move really quickly in this sector. The last year's demonstrated that. But are we beginning to expose the winners and the losers of this sector?
I think there's two lessons here. Number one, we have to adjust our thinking. It used to be that billions impressed us. Now it's trillions, okay? Because cumulatively, and our semis analyst expects the CapEx number to be $1.1 trillion in 2027. And the other thing is that the laws of size are just so evident, because if you heard your last guest, basically the spoils are accruing to the companies that now do other things well away from their original mandates, so that they are total enclosed ecosystems of AI, and you only do that with size that is evocative of the concept of trillions.
Are any of these going to become the next AOL? I mean, are any of them going to become rendered obsolete on some capacity as the world moves on and some of the behemoths win share?
It will happen at some point, but frankly, I'd prefer that doesn't happen. As a very young trader, I was sitting in the proprietary trading room when the AOL-Time Warner merger was announced in the beginning of 2000, and all the gray-haired vets looked at each other and said, uh-oh, I think this is over now. And of course, that was the top of the Y2K bubble. So let's hope it doesn't happen in AOL style.
You gave the sense that this feels a little bit like 1999. Are we in February? Are we in December? Are we December 31st? I mean, kind of where are we in 1999?
So the swing factor...
Pick a day, Julian, be precise.
My son's AI would. No,
well, I will tell you, I had a number of clients last night email me asking me to pick a day. It goes back to the economy's strength, which is inextricably linked to the amount of stress that's going to be caused by the elevated oil price. You remember, 1999, the Fed hiked 175 basis points to stop the bubble, which they did ultimately in Y2K. The question is oil going to have the same influence? The Fed... I don't care what the implied probabilities are. The Fed is not hiking this year, okay? That's, again, we said that a number of weeks ago. We'll say that now. They may not cut. And frankly, at this point, you'd rather not see them cut, because if you're going to get a cut right now, it's because the economy is weakening. But the point here is that we are in a time where if oil is the handicapping feature, you could have a sudden rollover, but again, we're not there.
Julian, it's good to see you. Thanks for joining us this morning. What are 24 hours in financial markets? Julian Emmanuel there of Evercore. The latest out of Iran, according to State TV. We're waiting for a statement from the supreme leader, someone we've not seen or heard much from over the past 2 months. That from State TV just moments ago. When we get that statement, those headlines, we'll bring it to you. Up next, Victoria Coates of the Heritage Foundation as President Trump reportedly weighs new options in Iran.
The problem we've got as an industry is when the governments overtax, and let's say they tax at 30 or 40% of net gaming revenue, what happens is it starts making it uneconomical for the regulated operators like ourselves. And then the customers land up going to the black market, and the black market don't pay tax, do whatever, and there's no customer, there's no responsible gaming, and the fiscals of these governments don't collect any money. So it's finding a balance between overtaxing and then not regulating. Anything from 15 to 25% of your net gaming revenue paid on tax is probably the right number. And when you start going above that, the metrics start becoming a bit more complicated for lots of the operators.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Q1 felt like a lifetime. April, blink and you missed it. Final trading day of April, up on the month on the S&P 500, higher by more than 9%, potentially on the S&P. The biggest monthly gain going back to November 2020, and we saw some big monthly gains back in that year. Equity futures this morning up by 0.2 on the S&P 500, on the Nasdaq up by 0.3. The S&P totally unchanged just yesterday in the face of these moves in the commodity market, which is crazy. 8 days of gains for Brent into today. We'll see if we make it day 9. We're pulling back this morning to 116.50. Over those 8 days, higher by 30% over that period.
And you have seen it bite in certain areas. At the same time, the technology trade has just overwhelmed some of the oil concerns. Semis with the best month, as you were mentioning, since 2000. Going forward, though, I think that what Julian Emanuel was just talking about is the key point. We're going to hit a breaking point. Stuart Kaiser was talking about this as well. And when you start seeing prices stay at these levels for even just a couple of more weeks, we might hit that point.
Getting closer. We're not there yet. We're pulling back on crude just for now. Let's turn to the bond market. There we've seen some pretty interesting moves. On 10s and 30s, the highest close of the year so far in yesterday's session, pulling back from those levels. 497 on 30s after having a little look at 5%. The 10-year was through 440, now back down to 439.47.
We hit 5% on the 30-year, and this came as global bond yields crept higher in the face of the oil price shock and potentially central banks led by the Federal Reserve that are not thinking of rate cuts anymore and, frankly, seeing actually a chance potentially of a rate hike, even though Julian Emanuel just said there's no chance in hell. And we also are getting that sense that they're not even willing to move to a neutral position. Nonetheless, this clearly is a quagmire for the central banks, and clearly it's being reflected among the bond traders.
And these are obvious headwinds for markets, but the earnings story has been so powerful in certain parts of the stock market in America. Take this one, just dropped. Caterpillar, first quarter adjusted EPS, 554, the estimate 463.
This is the industrial renaissance. You need this equipment in order to build stuff. And guess what? Everyone's building stuff. You also saw Ford beat expectations yesterday. People are buying cars. Every cylinder of the economy was set to actually outperform. And so suddenly you're seeing these earnings come through in a bold way. You're talking about how the earnings came in better than expected. Machinery, power, and energy revenue came in at $16.5 billion. That is more than $1 billion more than expected, to give you a sense of where some of these gains are coming from.
A few headlines I want to work through here, just away from Caterpillar and the earnings story. I mentioned we were waiting for a statement from the supreme leader in Iran. Those headlines just slowly crossing the Bloomberg terminal. AMH, what do you see?
So he's saying that there's a new chapter taking shape in the Gulf when it comes to the Strait of Hormuz. And that new chapter, obviously, is that the Iranians have full control over it. They're charging tolls and they're going after Western vessels. Still waiting to hear from him more. He says he's giving this statement on Persian Gulf Day, which they do every year. But Persian Gulf Day is to commemorate the Iranians pushing out the Portuguese in the 1600s from the Strait of Hormuz.
We'll come back to that story in just a moment when we have more. As we count you down to the opening bell, we're about 3 hours away. Lots of single names and morning movers for you. Yahara has more. Hey, Yahara.
Hi, John. We start with big tech, of course, and it all came down to who's seeing the payoff from AI. Alphabet clearly is. Shares are up 6.7% after a clear beat due to cloud growth accelerating, and Amazon shares also up after AWS posted its fastest growth in years, helping investors look past heavier spending. Now we get to the laggards. Microsoft down 1.5% after Azure just failed to impress investors, especially stacked up against Google and AWS. And at Meta, you're seeing a revolt from investors due to higher spending. So those shares down 8.7%. Turning to Qualcomm, those shares soaring 12% in the pre-market after CEO Cristiano Amon teased that they will be shipping custom AI chips to an undisclosed hyperscaler later this year, a sign they're getting into the red-hot AI data center market, that helping investors look past a softer outlook due to higher memory costs. And turning to another chip maker, Intel, those shares are up 3% in the pre-market after a 12% surge yesterday that brought the stock to a record high and seemingly inspired President Trump to tout the government's stake in that company, posting on Truth Social that he's very proud for making that investment and making the U.S. over $30 billion in the last 90 days because of this rally. John?
Yahara, thank you. Thank you very much. On our radar this morning, crude hovering near wartime highs on fears the U.S. is considering new military options in Iran. Axios reporting this morning that the president will receive a briefing from the CENTCOM commander after rejecting Tehran's latest deal. Elsewhere, the White House opposing a plan by Anthropic to expand access to its Mythos AI model. Sources telling us here at Bloomberg that U.S. officials are concerned the company lacks the computing power to guarantee security. And finally, the Trump administration blasting Jay Powell's decision to stay on at the Fed after his term as chair is complete.
It's highly unusual what Chair Powell did. This is a violation of all Federal Reserve norms, and it is an insult to Kevin Warsh, Mickey Bowman, and Chris Waller to think that these other Republican nominees do not care about the institution of the Fed.
The president writing on Truth Social, quote, Powell wants to stay at the Fed because he can't get a job anywhere else.
I love that he mentions the Republican nominees. Guess who else is a Republican nominee? Jay Powell, who actually was nominated by President Trump. So, I mean, in fairness, okay. On the other hand, the fact that President Trump didn't come out more severely against Jay Powell was interesting. I was expecting lawsuits. I was expecting a standoff. I was expecting potentially something further. Maybe people are saying this is going to give Kevin Warsh a bit of a reprieve, actually, in terms of his next steps.
We're going to spend some more time on this. We've got the whole morning to go through this. I think we've all got thoughts on what took place in the last 24 hours. Stay tuned for that. We'll also catch up with Neil Dutta a little bit later as well, I believe. Let's get to crude, hovering near 4-year highs with President Trump reportedly gearing up for a military briefing on Iran that could open the door for fresh escalations. Jonathan Tamari of Bloomberg Government joins us from Washington for more. Jonathan, welcome to the program. What do we know so far this morning?
So far, as we know, the president is supposed to receive a briefing today from CENTCOM commanders. Joint Chiefs of Staff Chairman General Dan Kane is also supposed to be there. He's going to get a range of options, according to Axios, from bombing, from more direct action to try to take control of the Strait of Hormuz, to potentially sending in special forces to grab the enriched uranium that Iran has. All at the same time, the president yesterday also told Axios that he saw the blockade as somewhat more effective than the military action that he's taken. So he's laying out a range of options, and you never know with the president what he's willing to actually do and what he's doing to build leverage in potential negotiations.
I'm not sure these headlines just crossing will help the diplomatic effort. Jonathan, thank you. We appreciate it. I just want to read some of the headlines coming from Iran's supreme leader. This statement brought to us by Iranian state TV that Iran will dismantle U.S. exploitation of Hormuz, that new management of Hormuz will benefit the region. I'm not sure if Gulf partners in the region right now would see it the same way.
Absolutely not. This is not acceptable to the UAE or Saudi Arabia or any of the Gulf partners that use the Strait of Hormuz. And also, some of them are also right there as well, like Oman, in that body of water. But of course, this is Iran's one piece of leverage. So what Jonathan is talking about in that Axios report, if the president wants to potentially use military assets, it might be just at the Strait of Hormuz. Maybe that means naval escorts like we saw in the 1980s. Unclear, but this is the piece of leverage that's starting to really hit the oil market.
Here's the take from Victoria Coates of the Heritage Foundation writing the following. We're going to have a tipping point in the coming weeks where Iran just can't sustain itself anymore. That's when the president will have the most leverage. Victoria joins us now for more. Victoria, welcome to the programme. This is a high-stakes blinking contest. With that, there is no doubt. Which side do you think is better positioned to wait it out?
Well, Jonathan, good to be with you. I think that for all the reasons you've been discussing this morning, the United States is best positioned to wait this out, if you will. And we have to look at what's actually happening to the Iranian economy. We had some really important reporting yesterday on the first metrics we've gotten out. And bear in mind, I mean, they haven't had a stock market for more than 2 months. It's been shut down. Nobody knows what their equities are worth, if anything. Their currency is down. If you look at it over the last 10 years, it's down 98%. And so you just have a lack of value in that country that is catastrophic. And Secretary Bessent was talking about this yesterday as well. The economic fury, the economic front of this war is what is sort of causing the devastating consequences to Iran. They can't go on that much longer. We're not happy about our oil prices. I think Julian was absolutely correct. This is putting a lot of pressure on what should be a very successful time for the economy. But at the same time, it's apples and oranges what's happening in the United States and Iran, and they're going to have to blink.
Victoria, no doubt that the Iranian economy is in dire straits right now. But how long can this administration deal with $107 and going north when it comes to WTI?
No, I mean, this obviously is something they're going to have to bring down. And I think that's why the president's getting that briefing today. And there are a range of options on the table. There always are. General Kane, the chairman of the Joint Chiefs, is someone in whom the president has enormous confidence. He's performed extraordinarily well over the course of really the last year and months, but very much over the course of the last 2 months. So they can look at the kind of military action that would force an opening of the strait. I might favor that personally. I'd want to see the details. We do have options in terms of our special operators who are specially trained to deal with nuclear material. So you're getting a person who's both a special operator and a nuclear scientist. That's quite a combination. I think we're the only ones who have that. They could go in and go after the highly enriched uranium. And you also have the infrastructure targets that the president's been talking about for the last week or so that would have that kind of final crippling effect on the Iranian economy.
Well, when it comes to opening up the Strait of Hormuz, in this Axios report, it says that such an operation could include ground forces. One source said, what would that look like?
Well, I mean, that you would have to see how, as I said, I want to see the options here. And there are a lot of reasons we shouldn't be seeing them. But at the same time, I mean, you can put people on the Iranian side of the strait to prevent them from using ships and missiles against any maritime traffic coming through the strait. You could put in some demining efforts to get rid of the some dozen mines they've theoretically put in there. So, and then you can have the naval escorts that you were talking about. So you can use our Navy assets to escort the ships through and prevent the Iranians from attacking them.
Yesterday, Victoria, we got signs that the U.S. Central Command is prepared to plan for a, quote, short and powerful wave of strikes on Iran. Do you have any sense of what this would be focused on?
I think in that case, Stephanie, we're looking at the infrastructure targets that the president was talking about, bridges, power plants, that kind of facilities. And this is going to be what would really shut Iran down, prevent people from moving around. We're already seeing these reports of their big industries starting to close. They've lost as many as 1 million jobs. And that what that would be crushing about this is there may be 10 to 12 million more jobs that would be at risk if the president took this kind of action. That's 50% of their workforce. So essentially 50% unemployment happens overnight to Iran. And you just wonder how the country can continue functioning after that.
Victoria, always good to hear from you. Thank you for the update. Victoria Coates there of the Heritage Foundation on who has the leverage and what the next steps might be.
Yeah, difficult to know when Iran is talking about new management. I'm wondering if they're going to put up a new sign, new management, under new management. Come through the Strait of Hormuz today.
On the Strait.
Exactly. Please come through.
I'm not
Here's
sure
our
that would
toll booth.
encourage people to go through.
I don't think that people would welcome that new management.
The Treasury Department just put out an advisory this week, not just to Americans, but really more importantly to foreign buyers, about if you pay that toll, you will have the consequences of U.S. sanctions.
Let's give an update on stories worldwide this morning. Let's cross over to Vonnie Quinn for more. Hey, Vonnie.
Hey, John, thank you. Shares of Qualcomm higher in pre-market trading. The chipmaker reporting growth in the data center market and predicting that the China phone industry would bounce back. Qualcomm also sharing a top hyperscaler is on track to start using its components later this year. Anthropic is weighing a fresh funding round that would value the company at more than $900 billion. Sources telling us here at Bloomberg, if successful, the AI developer could surpass longtime rival OpenAI as the world's most valuable AI startup. Saudi Arabia's public investment fund is ending its financial support for Live Golf after this season. Sources telling us here at Bloomberg, the league has already been engaging with investment banks to secure new long-term financial partners. The Upstart Golf League has an announcement scheduled to detail next steps. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Quite an update for the golfing world, that's for sure. Up next on the programme, Powell's. Stick it around.
After my term as chair ends on May 15, I will continue to serve as a governor for a period of time to be determined. I plan to keep a low profile as a governor.
You know that meme from Wolf of Research? Wolf of Research?
Exactly what I thought.
Right. Wolf of Wall Street?
Yeah.
Get my words out.
Leonardo
Post-Fed, never
DiCaprio
good.
comes out.
Yes, I'm not
I'm
leaving.
not going.
Yes.
Yeah.
Everyone cheers.
I think there's a new meme.
But there was no cheering.
I thought it was pretty cool too, right?
Get up. You're not keeping a low profile.
Ramo had a late night.
Well, we both had a late night. I mean, this
Did
is
they
what
mix
it is.
up the drinks at the table yesterday with TK?
Maybe. That would be fun.
Neil Dutcher of Renmac joins us next. Live from New York, you're watching Bloomberg TV.
Hello there. Just wanted to say, Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in Season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch Season 2 on all these lovely channels.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Equity futures picking up here, higher by 0.2% on the S&P. Similar move on the Nasdaq 100. Under surveillance this morning, he's not leaving.
After my term as chair ends on May 15, I will continue to serve as a governor for a period of time to be determined. I plan to keep a low profile as a governor. I'm literally staying because of the actions that have been taken. I had long planned to be retiring, and the things that have happened in the last 3 months have I think, left me no choice but to stay until I see them through at least that long.
Here's the latest this morning. The president blasting Jay Powell's decision to remain at the Fed after his term as chair ends, claiming he only wants to stay, quote, because he can't get a job anywhere else. Neil Datta of Renmac writing the bar to raising rate this year has just come down. For Walsh, it might be a waiting game. Neil joins us now for more. Neil, welcome to the programme. I think we want your initial reaction to the chairman staying on as a governor on the board of governors. How consequential do you think that decision might turn out to be?
Well, I think it's consequential. Obviously, it's not something that happens often. It hasn't happened in our lifetime, so you have to go back a long way. But look, I mean, nothing about this process since it started, when we had Fed Chair Celebrity Apprentice Edition, has been normal. So why should Powell abide by norms when, 1600 Pennsylvania Avenue isn't?
Neil, do you think it undermines, in the words of the Treasury Secretary Scott Bessent, undermines the other Republican nominees on the board?
No, they're all big boys and girls. They can fend for themselves, and they've done that. They've all shown themselves to be, independent and changing their views in the face of economic data.
Do you get the sense that President Trump was almost conciliatory in his lack of saying that he was going to fire him or anything that we were all expecting, and that moving forward, this can be sort of a footnote and not necessarily center stage in policymaking?
Yeah, I mean, I think the best way for the president to get what he wants is to not comment on the personnel within the Fed. I think right now, we'll see what happens with the Lisa Cook investigation. I mean, my sense is that Powell's probably waiting for some clarity around that before he makes his next move. And I think my advice to President Trump would be, don't take the bait. Don't take the bait. I mean, if you try to Lisa Cook Jerome Powell, I don't think it would go well for the administration, but more importantly for the financial markets.
The other aspect of this press conference was the fact that there were 8 people who voted to keep the rhetoric the same. There were 3 people who voted to move to a more balanced, more symmetrical risk. And there was 1 person, Stephen Myron, who voted to cut rates by 0.25%. Do you think that it's a mistake to move to more symmetric language where the next move could be a hike or a cut?
I think it would be a mistake. I think it would be a relatively small mistake in the face of the data that we've seen. I mean, at the end of the day, as Powell mentioned, I mean, it's hard to argue against the idea of lowering the bar to hikes, which is, I think, what happened yesterday. Inflation has been strengthening. There's reasons to expect additional pass-through from higher energy prices into core inflation. And, the economy is bruised, but not yet really battered. I mean, this is a resilient economy, and I mean, it's kind of defied my expectations.
Can we just check the line quick and make sure this is Neil Datta?
I honestly don't know if this is Neil Datta. I was expecting a discussion about labor.
It's Neil?
I don't know.
It's actually Neil?
Maybe it's just simply a hologram.
Neil, this feels like a change. Is that fair?
Well, I mean, I'm a sell-side analyst, John. When the data changes, you have to change your view, or you start losing clients because no one wants to listen to you. So you have to kind of adjust with the times. And I think you've seen that. Look, I'm not the only one. You know who the other person is? Christopher Waller has changed his views. He's been kind of a little bit more, I guess you can say, sanguine. It doesn't mean that there aren't risks out there. In fact, I continue to see them. But I think for right now, you have to kind of tip your hat to the economy and say things are stable. We'll see where we stand at the end of the year. We will have fiscal policy transitioning from a tailwind to a headwind. The Fed is on hold. Labor market conditions, I think particularly wages, are still probably cooling somewhat. Right now, we're kind of in the throes of this spectacular AI kind of CapEx boom. But we see what the risks are, particularly overseas. But right now, I think if you're a Fed watcher, you kind of have to just watch and wait.
Well, Neil, Julian Emanuel, who was on earlier, basically said that we only have 2 more months where this economy could sustain triple-digit crude. And if you look out into July 4th, in the futures market, it's actually at $100. That's what they're pricing. Where do you see a breaking point?
Well, I think the important thing is right now the break is very linear in nature. I mean, I think over time, as people feel higher gasoline prices, I mean, remember, income growth going into this wasn't any great shakes to begin with. So we are going to see weaker real income growth, and that in turn, I think, will, gravity will prevail and pull down real consumer spending. But that's still very much a forecast, not a present-day reality. And given where inflation is, the economy breaking has to be a present-day reality. I mean, that to me is the primary tension right now. I mean, the Fed doesn't really have your back if you're an equity market investor. The Fed is basically waiting for the unemployment rate to rise before doing anything. So that's kind of where we are right now. But we kind of need to see it before they move.
A data-dependent Neil Dutta. Neil, good to see you, as always. Neil Dutta there of RunMac. To Neil's point, Governor Waller has changed his view somewhat. Neil's changed his view. Secretary Besson has seemed to have changed his view as well, saying that he's more understanding of a Federal Reserve if they keep interest rates on hold for the time being, at least for now.
That's what the market is coming around to. I mean, Bob Michael yesterday, similar kind of move. We were talking about rate cuts to start the year. Now he's saying, actually, it doesn't seem that likely. It does feel like this is a sea change, and it does feel like people have been surprised by the strength in the economy. At what point does the corporate spending from the big hyperscalers potentially triumph over the weakness that we would have been getting because oil prices are this high?
The bar for hiking is still high. Most people would agree that the bar for hiking is still high, but the bar got a little bit lower. And that's the development of the last 24 hours.
It's actually getting priced into the market. There's a 40% chance of a rate hike coming up through March of next year. Look, will they do it? Julian Emanuel says no way. At the same time, the fact that it's getting introduced in price action gives you a sense of what's going on.
And at the same time, oil prices just keep going up. Gasoline prices in America are going up. And what did Kevin Warsh say at the start of his hearing? Inflation is a choice. Well, if it's a choice, then he is going to be at the head of the Fed who could potentially work to bring that inflation down.
Do you know what else keeps going up? Stocks. Equities up again this morning on the S&P by 0.2%, staring down one of the biggest monthly gains we've seen on the S&P 500 since 2020, higher this month by close to 10%.
What did we get? Yes, we got the hyperscalers that beat expectations or met. You get some modeled performance just based on the CapEx plans, but you have Ford outperforming, Caterpillar coming out. I do think it's important to reiterate what we just heard. You talked about the headlines, John, the idea of the beat on earnings per share. Their machinery, power, and energy revenue is $16.5 billion. This is directly tied to the build-out of energy infrastructure and AI. That was versus an estimate of $15.4 billion. I mean, this is just massive stuff.
Some interesting moves this morning. Looking at dollar yen as well, 2% move, 157, some yen strength. We're on the brink of intervention, real threats coming from the Japanese Finance Ministry. We'll spend some time on that in the next hour. Up next on the programme, we'll catch up with Sharmin Mossavar-Rahmani of Goldman Sachs, Clayton Siegel of CSIS, Mike Wilson of Morgan Stanley, the former Boston Fed President, Eric Rosengren.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
A cidade estava sitiada.
Isso, ao começo, eu tremia, não sabia o que fazer. Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home, they are suffering.
and someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Our policy stance is in a very good place for us to wait and see.
I just don't see any need for the Fed to really change its bias or react in meaningful ways.
Odds of cuts later this year certainly should go down.
The market already took the easing bias out.
Don't expect any changes in rates this year. That's cuts or hikes.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures bounced by 0.2% on the S&P 500 on the final trading day of April, looking for a gain this month of more than 9%. On the Nasdaq 100, up by 0.2%. In the commodity market, some stress building for 8 consecutive days coming into Thursday. A 30% move over that period on Brent crude. We pulled back by close to 2%. Brent crude this morning at 116, WTI at 106. Heading into this, central bank decisions galore in the next 60 minutes. The Bank of England decision just dropping. Interest rates unchanged. Up next, the ECB at 8:15 Eastern Time. Later, some economic data and Apple after the close.
Oil is doing a lot of heavy lifting in the wrong direction for these central banks. And one thing that Andrew Bailey said of the Bank of England was that there is a risk of material second-round effects. This is the fear percolating through markets. And all these people who believe that the Fed could previously cut rates significantly and other central banks as well are now coming around to the idea that maybe not, because right now we're dealing with an economy that can handle oil prices where they are. And potentially you could start seeing the trickle through in places like, hey, CapEx spending, but the likes of Meta that has to go up because of how high commodity prices.
We've priced in hikes at the Bank of England. We've priced in hikes at the ECB. We've priced out the easing at the Federal Reserve. And this bond market has responded accordingly in the past few weeks.
You're seeing yields at the highest levels, at least in Japan, going back to the late 1990s. If you take a look at Europe, you're looking at the highest levels going back to 2011, 2008 for the Bank of for gilts. At this point, when does that torpedo growth? When does that torpedo capital markets activity? Not yet. And that is where the second round effects could come into play if this tightening doesn't work as a lot of people expect.
We'll head over to Lizzie Burden outside the Bank of England in just a moment. Need to work through the latest in the Middle East as well. The latest reporting from Xauusd suggesting the president is slated to receive a briefing on new plans for potential, and I stress potential, military action in Iran. The latest from Xauusd this morning.
What was interesting, too, about the report is one option would be to try to open up the Strait of Hormuz in a military fashion, and that would require, one individual said to Axios, that would require boots on the ground. We just heard from the Supreme Leader of Iran, an individual that we haven't seen, but we've seen a few statements from, and says a new chapter of the Persian Gulf and the Strait of Hormuz is being written, and they're talking about how it's basically under new management when it comes to the Strait of Hormuz. That's the tolls and the fact that they have absolute complete control over it.
Let's set up the next 60 minutes, and then we'll get to the Bank of England decision for you. Coming up this hour, in just a moment, we'll catch up with Shamin Mossavar-Rahmani of Goldman Sachs with more tech earnings on tap. Clayton Siegel of CSIS as crude climbs through 115, through 120 at one point. And the former Boston Fed President, Eric Rosengren, with Chair Powell planning to stay on at the FOMC. Let's get to that Bank of England decision then. Crossing just moments ago, Lizzie Burden has the headlines. Hey, Lizzie.
Hey, John. Well, as expected, the Bank of England has held rates at 3.75%, but it's really the commentary around this decision that is in focus here. 8-1 was the vote split, as expected. The chief economist of the Bank of England, Hugh Pill, dissenting to hike rates now. He's worried about the second round effects, and a lot of emphasis on the second round effects in these new scenarios that the Bank of England has put out. So this is the first set of forecasts that we've had from the bank, the first complete set of forecasts since the start of the Iran war. And indeed, if we just go into what they say, in all scenarios, rates would be going up. Now, the Bank of England has maintained its guidance that it stands ready to act as needed. That's what they said at the March meeting. Remember, there was no press conference that time, but it set off a massive market reaction that the governor had to walk back. This time, they've scrapped the central forecast in favour of these three scenarios. No second round effects in scenario A, some in B. In C, they'd be material. And so you've got different members of the Monetary Policy Committee putting different emphasis on these scenarios. But if you look at it, in C, CPI would peak at 6.2% in the first quarter of 2027, unemployment at 5.7%. As I say, rates rising in all three scenarios, and different members of the Monetary Policy Committee emphasising which is most likely. But for Pill, the dissenter here, he says the risks of second round effects are skewed to the upside, and that's really what matters here when you're listening to him. Look at the market reaction. Interesting to see that gilt yields on the 10-year have fallen. We're down 6 basis points at 5.01%. So compare that to before. We had higher gilt rates, yields. We were in a jittery market anyway. You'll note the reaction to the March decision. We're factoring the energy price shock. We're also factoring in the political risks here in the UK.
Are we on the edge of a policy mistake in Europe? Lizzie Burden, thank you. We'll hear more from the ECB a little bit later this morning. These are central banks, and the market is pricing in hikes for the year ahead at both the Bank of England and the ECB. And to some extent, I think the words of Hugh Pill this morning, the chief economist at the Bank of England, validating some of that market pricing.
Saying ultimately he thinks they should hike right now. Just to note that in scenario C that Lizzie was laying out, they would say forceful action would be warranted in terms of tightening. So that would come with an inflation rate above 6%.
Here's the view on Wall Street this morning. Stocks looking for some direction as big tech plans another massive AI spend in the face of what could be tightening central banks worldwide. Joining us, Shamin Mossavar-Rahmani, the Wealth Management CIO and head of the Investment Strategy Group at Goldman Sachs. Shamin, it's good to see you.
Hello, thank
you for being here. Are central banks about to become a headwind to this equity market rally?
We actually had a very good exhibit on one of our client calls. If you look at the 21 past strikes that the U.S. has had on the Middle East or North Africa, up to 8 weeks after the initial strike, the equity markets have been up on average 4%. And that's exactly where we are. So everybody's saying, oh, the equity market is going ahead. How can they ignore the price of oil, whether it's WTO or Brent? What is exactly going on? Growth is still robust. Obviously, we're going to get Q1 numbers, but I think nobody's thinking that we're in a recession is imminent. And if you look at the earnings we've gotten, they've been incredible, right? Substantially greater than consensus. And this is a pretty significant, in terms of exceeding expectations, it's a pretty significant number. It's not like, oh, we exceeded earnings by 2%, 3%, 5%. It's double digit. And if you look at the number of quarters where we've exceeded expectations, the number of consecutive quarters, it's just incredible. And so when people talk about the impact of the war, We have said the U.S. economy is unbelievably resilient, and people continue to underestimate that. So as we look at this, I don't think anybody knows exactly how long this will last. If it lasts a lot longer and oil prices stay at these levels, then the economy will be weaker. And so the idea that people can raise rates in the face of weakening economy, especially in the U.S. when you have a dual mandate, I think we need to factor in a lot of uncertainty.
Do you think that there is a lack of logic when people say, well, oil prices are at this level, and you see still that robust growth in the economy, so that means that the inflationary impacts can get passed through much more directly and easily because of the CapEx spend, because of how well these companies are doing. Do you see that as a logical connection, or do you think it just hasn't been long enough with oil prices at this level?
There are actually 2 points. You're right. It hasn't been long enough. So that's number one, because if this war were to last and we see oil prices here, eventually we will get to negative numbers in the equity market. But for now, the idea that we're up 4 or 5% is actually totally in line with history. And from our perspective, one of the pillars of our investment philosophy is history is a useful guide. So first we have that as the backdrop that we need to follow. The other thing that people need to think about is the energy intensity in terms of usage of oil is a lot different than the early 80s. So when we had the Arab oil embargo, then we had the Iran-Iraq war, we had the Iranian Revolution, prices skyrocketed. But at that time, the energy consumption in the US in terms of barrels per capita per year were substantially higher. In fact, it was around, let's say, 30 barrels a year. That number is down to around 23, 24 now. So there's also a view that energy, crude oil, will not impact as much. Obviously it will. Fertilizers, we hear about all of these things, but it has to last a while.
It does affect the cost of components, and we saw this with some of the hyperscalers reporting earnings last night. Meta, for example, increased their expected CapEx in part because of higher component costs, maybe also because of some of the transportation issues that people are experiencing. At what point does that become a sticking point, maybe not for the biggest tech companies, but for some of the tech companies out there that are facing an existential threat but are having to pay that much more to even play ball?
I think there is a big question mark about the returns to the CapEx for AI companies. The hyperscalers obviously have so much cash flow from other factors that they can do quite well. And if you look at their earnings, whether it was the latest reports or last year's, they've just been phenomenal. But the rest of the economy is actually doing quite well, and people underestimate, again, the resilience. If you think about oil production in the US produces double the levels of Saudi Arabia. Right? It's just incredible. You think about natural gas. The U.S. has become the largest exporter of natural gas literally in 10 years, far exceeding Qatar. So as we think about these factors, people need to think that the shock is not as great. And at the end of the day, both sides want to end this war. The question is, what is a respectable off-ramp for both sides? And I think the market is saying we will get there. Well, there'll be fits and starts, escalation, de-escalation, and we're going to have to go through that. And that's why we recommend our clients stay invested. Don't try to time this market. Nobody can do that consistently very well.
But in the beginning, conventional thinking was 4 to 6 weeks. We're now 8 to 9 weeks into this war. How much longer, with these kind of elevated prices, do you think the economy could withstand? Julian Emanuel says July, and then things might start to break down. Do you have a date where you're looking at?
Not really, because nobody really knows, right? If you look at the probabilities, it's not as if it's so obvious how long this will last. I think we know both sides don't want it to last July and August.
Not the conflict. How long the economy could withstand triple-digit crude?
Well, in the U.S., we're just around triple-digit, right? And we've been here before, and prices lasted at these levels for a while. I don't think the economy is going to break. We had initially expected GDP to be around 2.3 when we started, then momentum 2.4%. Now, because of the war and oil prices, we've lowered it to 2.1%. But we have a very low probability of recession, even at these levels, if prices were to stay here. I think to say exactly, is it July? Again, if you believe the resilience of the economy and adjustments, and we're talking about the U.S. that has ample crude and natural gas, right? It's really the rest of the world. And if the U.S. is a big importer and less of an exporter, then not in terms of hydrocarbons and things like that, but in aggregate, the damage to the economy is going to be much less than it is, for example, to Europe or to China.
Do you think we're moving into a phase where the offset to equity risk is increasingly gold and commodities and not developed market bonds, which increasingly are subject to potentially spending issues, deficit issues, as well as just the natural inflation in the system?
That's a very good question, because all our clients are asking us, how can they hedge against the risk of war? And we tell clients that at the end of the day, the best hedge against inflation has been historically U.S. equities in aggregate. So in fact, that's why, again, we say stay invested. Gold is not a good inflation hedge and not a good deflation hedge. So the idea that gold is something you need to have in your portfolio is something we totally disagree with. We don't think it's really part of a client's strategic asset allocation. And tactically, we've actually said that when you see these kinds of price increases driven by central banks, especially initially by China and then countries like Turkey, Poland, clients shouldn't be caught up in the euphoria and the momentum of gold. And obviously, we've seen a pretty significant decline from peak levels.
Seen a big turnaround. Shamin, it's great to catch up with you. Thanks for being here.
Thank you.
Thank you. Shamin Mustafa Rahmani there. Equity futures this morning, positive by 1/3% on the S&P 500. A bounce back here. A Bank of England decision just moments ago, falling short of some of the hawkish expectations. Very, very hawkish pricing in this market ahead of this decision. An 8-to-1 vote, to some extent falling short of that. That one vote, though, that one vote is that endorsement this market was looking for of a central bank that might be getting closer to hiking interest rates. But that's all we've got.
And frankly, the 8-1 decision highlights how difficult this really is for England. Right now, the fact that they're talking about north of 6% inflation, at the same time 5.7% unemployment, that is uncomfortable.
Some of the hawks just in a holding pattern at the moment. Yields pulling back on gilts so far this morning. Let's keep an update on stories worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. President Trump defending the U.S. blockade of Iranian ports, saying it's more effective than bombing the country. Trump rejecting the latest Iranian proposal to open the Strait of Hormuz and lift the blockade until concerns about Iran's nuclear program are addressed. Axios reporting the president will receive a new briefing on the situation today. In his final meeting as Fed chair, Jerome Powell announced he will remain on as governor after his term ends next month. Powell saying he felt he had no choice but to stay amid a series of legal attacks.
I'm literally staying because of the actions that have been taken. I had long planned to be retiring, you know, the things that have happened in the last 3 months have I think, left me no choice but to stay until I see them through at least that long. You know, in addition, I don't see how this will interfere.
The president blasting Powell's decision, posting, quote, Powell wants to stay at the Fed because he can't get a job anywhere else. Shares of Bill Ackman's Pershing Square down 18% in its market debut. The fund raised $5 billion in its IPO, falling short of the $25 billion it had originally sought to bring in. Ackman aims to build a long-term diversified holdings company such as Warren Buffett's Berkshire Hathaway. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thank you very much. More from Vonnie later this hour. Up next on the programme, curbing the crude surge.
Nobody likes, of course, high prices in the short term, but they understand increased American energy exports, increased energy addition policies, lean into more energy production. That's what President Trump is all about.
Up next, we'll catch up with Clayton Siegel of CSIS, live from New York City this morning. Good morning.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
So here's the bounce. A little bit of a turnaround cross-asset. Let's start with equities. We're positive. Didn't do much yesterday. Positive by 1/3 on the Nasdaq, up by 0.4. Lots of tech results we need to talk about. Let's turn to commodities. A turnaround there. 8-day streak of higher oil prices broken this morning. That's the longest daily streak going back to May 22. We're down by 2.7%. 115. Even with the threat, and I stress potential threat of military action in the Middle East, given the latest reporting from Xauusd, crude pulling back. That's notable. That's helping yields drop, just opening up some space for yields to pull back. 2s, 10s and 30s. 2s down 5 basis points, 10s down 4. And then this move in dollar-yen. Let's bring up the chart. Brutal stuff if you're on the wrong side of this. Dollar-yen, negative 2% in the yen's favour. The Japanese Finance Ministry with a range of headlines this morning. Tell you what, verbal intervention takes on a new twist from Japan. This is your final warning. Get ready. We're close.
Yeah, stay close to your phones because ultimately we might take action at any time. So I can just imagine the alarms people have set.
Yeah, that's not the trade you want to be on the other side of. This morning at least, dollar-yen, 157. Under surveillance this morning, curbing the crude surge.
The critical outcome here is that we end the ability for Iran to have a nuclear weapon. So look, we're going through a period of discomfort to solve a 47-year crisis. Nobody likes, of course, high prices in the short term, but they understand increased American energy exports, increased energy addition policies, lean into more energy production. That's what President Trump is all about.
Here's the latest this morning. Crude hovering near 4-year highs as the U.S. weighs new military options in Iran. Axios reporting President Donald Trump is preparing for a briefing with the head of U.S. Central Command later on today. Clayton Siegel of CSIS writing global balances are heading for a 1 billion barrel shortfall, with fuel prices increasingly likely to hit corporate earnings, consumer wallets and GDP growth. Clayton joins us now for more. Clayton, and yet the blockade continues. How much storage do you believe Iran has left?
Hey, good morning. You know, it probably has several weeks worth of storage left, but I think that the market and observers are maybe over-indexing on how much pressure a potential shut-in of production is going to play in Tehran. I mean, they've had to pare back production and shut in wells in previous episodes when sanctions were really hitting hard, and they have had the ability to scale back up after that. So I think this kind of the story du jour that's making its way through markets, that it's going to result in some kind of permanent damage that they need to scramble to avoid, it might be a little bit exaggerated. But instead, we could really look at the effectiveness of the blockade in keeping those ballasting tankers, the empty tankers, from getting into the Gulf in order to serve as floating storage. So all of these things kind of go together in terms of their storage capacity.
But Clayton, if they're using these empty vessels to store some of these barrels, when they hit tank tops, what happens next?
So if they can't get more empty tankers in order to keep loading at places like Harg Island, then they will have to organize a program of turning down production in the fields. But remember, that's also what the other Gulf Arab producers have been faced with in the last couple of months. So Saudi Arabia, UAE, Iraq, Kuwait, they've all had to turn down production because there's nowhere to physically put the oil at the earlier production limits because it's just not getting out of the Gulf. So of course, Iran is in the same boat as the rest of them. But the question is, can a production downturn be organized by the engineers, by the geologists to avoid any kind of lasting damage? That's question number one. And I think the answer is probably yes, because they have experience and track record of doing that in the past. But then the second question is, you know, do the decision makers, do the powers that be in Tehran really care that much? I mean, these are the same people that went against their own population with a very severe crackdown recently. And so I'm not sure that they're going to be motivated necessarily by the long-term vision for Iran's upstream industry.
Right. We have seen Iran deal with that in the past. What about Gulf partners that are also dealing with potential shut-ins at wells?
And we've had more than 13 million barrels per day of oil production downturn during this crisis. And this is all because the Strait remains closed. So when I was looking at the blockade proposal a month or so ago, I think the idea there was it could really be a force for good just to temporarily level the playing field and to send the message to Tehran, hey, look, if everyone else's vital energy exports can't get to market, you're going to have a hard time getting yours out too. But then immediately use that opening to resume diplomatic negotiations and find a mutually acceptable off-ramp to this crisis so that the exports can resume and so that the global economy can rebound and be protected. But the Trump administration's handled it a little bit differently. They announced at the same time of the blockade being imposed earlier this month that it's going to stay in force until a final agreement is reached. So that's not really a temporary bridge. That's kind of keeping the chokehold on Tehran unless and until we have a final settlement, and apparently that hasn't played very well there.
Clayton, what does a mutually acceptable agreement look like that really removes the risk that Iran could do this again?
I think that the key point is that both sides are going to have to climb down from maximal positions. I mean, it can't be that Tehran has a complete chokehold over the world economy going forward. Exporters and their customers don't want to hear about a permanent tolling arrangement. So I think that they should make compromises on that front. From here in Washington, to try to architect a deal related to uranium enrichment that is even stronger than the previous arrangement, the so-called JCPOA that was negotiated under the Obama years, that's a high hurdle. So if both sides can just get their must-haves out of a diplomatic agreement instead of the nice-to-haves, I think that there's room for progress.
Clayton, appreciate your time. Thank you. Clayton Siegel there of CSIS down in the nation's capital in Washington, D.C. It's difficult to please everyone because so many parties are involved. And it's not just the U.S. and Iran. It's nations across the Gulf as well.
Even if you get to a place where suddenly people can go through the Strait of Hormuz, but Iran has the ability to potentially reverse course, what kind of premium starts getting baked into oil prices? And you're going to get a lot of those pipelines that are being diverted in other directions from the other Gulf regions just as quickly.
Are shipping companies going to have the confidence to go through the Strait of Hormuz, even if the United States says we feel like it's safe and it's open? It took about 6 months for the Red Sea to get a little bit back to a normal cadence. And that was when the Houthis, this is on a totally different level when it comes to Shahadi drones and the IRGC on speedboats.
I remember when it opened 2 weeks ago. Do you remember that? 2 Fridays ago, Strait of Hormuz is reopening.
Verbally opened, not physically opened.
Of course. And then it didn't at all.
People are brilliant because if you go online, there are all these people. There's actually a Google review for the Strait of Hormuz, and it has 1 star.
Seen that.
And it has, it has
pretty
the
high,
dates.
1 star.
Well, it's because you can't get lower than that. And it's Monday, maybe open from 8 a.m. to 8 p.m., Tuesday close, Wednesday close, etc. And now I can just imagine it has a big banner over it saying,
it's farcical, isn't it? Yet it's really, really serious.
But that's the whole thing, exactly.
And you've got countries across Asia getting crushed by this because they haven't got access to the energy. It's not just a price story. As we've said repeatedly, it's a shortage story.
We're seeing this come through in the economy and the economic performance. Europe underperforming today, and we see that consistently as a result of this.
Underperforming, and yet some central banks still at least discussing the potential for rate hikes, which just seems crazy.
One mandate, not a dual mandate, and is that going to change?
The potential for second-round effects when your economy's not that strong, though. That's my struggle.
Great question.
It's my struggle. Mike Wilson,
John for ECB
of Morgan Stanley, up next.
Least tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg. For up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate.
More than what you need to know, it's what you need to think about.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
The Bank of England decision just behind us, the ECB decision ahead of us at 8:15 Eastern Time. 30 minutes later, a news conference with Christine Lagarde. We'll take some of that right here on Bloomberg TV. After that, we'll get some economic data. Jobless claims coming at 8:30 Eastern Time, a host of other data points as well. Then after the close, we get numbers from Apple to wrap up a big week for tech results. Equity futures so far this morning, your scores look like this. Higher by 0.4% on the S&P 500, up nicely on the Nasdaq, up by 0.6 to add to a pretty impressive monthly gain so far. I think of more than 14%. Which would be the biggest monthly gain going back to, I believe, April 2020. And we saw some big gains back then.
Yeah, if you take a look at some of the performance over the past month, April is poised to be the best month for the NASDAQ 100 since 2020. The S&P tech sector is poised for the best month since 2002. And if you look at semis, you got to go back to 2000 to get to these levels.
Crazy.
So it's, driven by a particular area, let's be honest. You've been pointing this out, though. Energy stocks, the worst performers.
They've done nothing.
I don't understand this. I mean, we've been talking about
Chevron,
this.
done nothing for 2 months.
They've actually lost. I mean, this is sort of the question. What are we looking at here?
Crazy, isn't it?
Yeah.
Even with these moves in crude, close to 115 this morning, pulling back to 113, briefly through 120. We had an 8-day run of higher crude prices on Brent, up over the period by 30%. Declining this morning on WTI, we're down by 2 to 3 percentage points. That's unlocking this move in the bond market because yields yesterday, 10s and 30s, closed at the highs of the year, pulling back from those levels, down 4 basis points on 10s, 439, down 5 on 2s to 389.
At what point does it start to bite into some of the enthusiasm that we're seeing in markets? I feel like a Debbie Downer this morning when I mentioned that because when we talk about it to analysts, they say, we're managing just fine and it's not going to stay here. But right now it does feel like we keep creeping higher in the developed markets. And at some point, when does that start to put a crimp on some of the capital markets?
Just the chorus in the control room. Only this morning? Just this morning.
Normally I'm really optimistic. I mean, come on.
So
we're talking,
upbeat on a daily basis.
Well,
it's overwhelming.
Usually, normally, you should listen to my conversations at home.
I imagine.
They sound
What was it about last night at the dinner table?
Human versus AI and
humans
the
just won't have a role, it's over.
The offspring
are taking over.
Long AI, short humans.
The Terminator is happening at our house.
Does the mood get better through the day and then decline again at night? Is that how things work?
It depends. Again, do me, but with a smile.
Okay. As we count you down to the open about, I love it. 2 hours away from the cash open. Let's get you some morning movers. Yahira has more. Hey, Yahira.
Hi, John. We're getting a wave of earnings this morning, and we start with some standouts in the pharma sector. Take a look at shares of Eli Lilly, up more than 7% in the pre-market after it raised its guidance due to booming demand for those weight loss drugs. Lilly's saying that its latest one, that pill, is off to a great start. Merck also, it was a beat there due to strong demand for its newer drugs as its older ones face expiring patents. Moving on to Royal Caribbean, those shares also rising 7% in the pre-market. Investors looking past weaker guidance due to higher fuel costs tied to the war, and they're clinging on to this. Royal saying that after a dip in March and April, bookings have recovered and are even running ahead of last year. And we end on Caterpillar, those shares also rising in the pre-market, up nearly 5% after a massive beat as this legacy industrial name becomes part of the AI build-out. Caterpillar seeing huge demand for its generators and gas turbines, of course, part of the AI data center build-out. John?
Yahara, thank you. Thanks for the latest. That stock higher by close to 5%. On our radar this morning, Alphabet surging as AI demand fuels a cloud computing boom. Meta lagging behind after a massive budget hike weighs on the stock. The four companies, including Amazon and Microsoft, are expected to spend more than $725 billion in 2026. Elsewhere, crude hovering near wartime highs. On reports, the US is weighing new military options in Iran. Axios reporting this morning that the president will receive a briefing from the CENTCOM commander later on today after rejecting Tehran's latest deal. And finally, the president blasting Jay Powell's decision to remain with the Fed after his term as chair ends, writing on Truth Social, quote, Powell wants to stay at the Fed because he can't get a job anywhere else.
And we've been talking about how that's really tame. I mean, ultimately, we were talking about potential war in the court system. Does this matter? And ultimately, what is the best strategy for everyone moving forward? What does it mean for him to take a low profile and to stick around?
To just move forward and move on, I hope. I think that is the best strategy.
Well, that's what a lot of people would suggest, but what is he waiting for? Is it the Lisa Cook or is it something else? And when can we move past the Bachelor?
It could be the Fed Inspector General report. It could be what's going on with the Supreme Court and Lisa Cook's seat. I think Neil Dutta hit the nail on the head when he said the White House hasn't handled this process normally, so why should Powell be expected to handle this process normally? I do think it's interesting, though. Powell's a dove. Does anyone think he's a hawk? Maybe the White House is actually like, whatever, at least he's going to vote in our favor.
He had rates at zero at multi-decade lows when inflation was at multi-decade highs. It's hard to call him hawkish.
My favorite part is that talking about Republicans and how this undermines the Republican-appointed nominees to the Fed. Well, guess what? Chair Powell is a Republican nominee. In fact, it is President Trump's own nominee. So, you know, let's really park this. And by the way, Kevin Warsh is an inner hawk, so let's be clear about that.
I was hoping for that follow-up question. But, sir, isn't Jay Powell the president's own nominee, but we didn't get it?
Well, obviously, you watched the channel that interview took place on, so you expected the follow-up? I mean, come on, it's very predictable stuff.
It was an easy follow-up. I just wanted to hear what Besson had to say to it.
Follows a script on the hyper-partisan news networks in America. You know this. We'll catch up with the NEC director a little bit later to talk about some of these issues. Kevin Hassett joining us at 9:30 Eastern Time. Let's talk about tech. Four of the Mag 7 beating expectations and planning a more than $700 billion AI spend. Mike Wilson, Morgan Stanley CIO and Chief Equity Strategist, writing, our factor work shows the market is broadly rewarding higher capital spending as cyclical and structural forces encourage CapEx. Mike joins us now for more. Mike, good morning.
Good morning.
Can you build on that a little bit more? Because we got some pushback to the likes of Meta. How universal is that take?
Yeah, I mean, this has been a call we've had for quite a while, and this is part of the rebalancing thesis. I mean, the administration is encouraging more CapEx, and the good news is that the market is rewarding more CapEx, not just with the hyperscalers, but more broadly. And I think this is an interesting question to think about. First of all, 4 weeks ago, we did step in pretty aggressively on the hyperscalers. We thought they sold off way too much, and people were kind of punishing those stocks in a way that they got very, very cheap. And now they've rallied quite a bit. Now, if you look at the other stocks, that benefit from CapEx, they're also working. Some of the industrial names, some of the parts of the economy that are going to see this. That's part of the big beautiful bill. That is the story, right? More investment, less consumption to get higher productivity. So this is a broader thesis than just AI CapEx. I think it's really important that companies continue to allocate capital in a way that leads to higher productivity. That's the strategy. That's what we're trying to achieve.
That's kept you bullish throughout all of this over the last 2 months. We've all been following your research. How insulated are we in this equity market, not the economy, the stock market, from what's happening elsewhere abroad in the Middle East?
Well, look, it comes down to earnings. I mean, if companies are growing earnings 15, 20%, and the forward earnings expectation is 25%, they're not going to be laying people off or restricting themselves on capital spending or doing things to make their businesses grow. One other thing, a theme that we've been talking about for years is this inflationary regime, okay? So if you're in an inflationary regime and the Fed now has real rates close to 2%, which is, kind of restrictive in some ways, okay, we got to find a way to grow, like organically. And so this is a real change over the last 15 years when it was all about financial repression, buying back stock, borrowing at negative rates. companies got to invest real capital, take real risk to generate real returns. So who do you want to bet on? You want to bet on the companies that are high quality, that have done that in the past, have generated high returns on capital in the past.
Does this still support the idea of a broadening out trade, given the fact that it is the biggest companies, and a lot of the big earners have been the hyperscalers that have the ability to invest, but the consumer on the margins, I hate saying this, but is being more choiceful, choosier, pickier, because they don't have as much discretionary spending. That's
right. And so, I mean, the consumer statements have not performed well in the last month or so. So, in other words, the market, everybody says, oh, the market's ignoring these high oil prices. I don't think so. I mean, you look at some of the consumer retail names, you look at the airline stocks, things tied to higher oil prices have underperformed. So the market has just moved away from that for areas that are somewhat insulated, to John's question. All right, so we still think the broadening story is happening. And the reason we're saying that is because the earnings story is telling us that. Earnings growth for the median stock in the Russell 3000 is now well into the double digits. That's the first time we've seen that since 2021. That's why we had the broadening call for this year. So that, to me, that's the opportunity now. Everybody's crammed back into sort of the same name, saying it's only a handful of stocks. No, there's a lot of companies, businesses that are doing quite well in this environment.
When would the bond yield backdrop start to worry you, given the fact that we have seen the long end of the yield curve creep higher?
Right here. It's 440 has been, we've kind of rejected that a couple of times in the last few months, and we've seen the Fed and the Treasury intervene in both cases, right? Jay Powell with a little bit of dovish rhetoric on the 30th, the Treasury doing bigger buybacks, more bill issuance. They have these gains. We've written about this extensively. What I'm watching is two things. 450 on a 10-year. We've established that in the last couple of years. We're not quite there. But more importantly, bond volatility. Okay, so the MOVE index, was up around 115 back at the end of March, related to oil prices and the Fed getting a bit more hawkish. And then sure enough, the Treasury and Fed stepped in, and now that's down to like 70. That's totally cool. So I'm watching bond volatility. If that starts to pick up with rates at 440, 450, we could have a decent correction of, say, 4 or 5%.
We're looking at corporate credit as well this morning. This headline just crossed in, Lisa, one for you. Meta kicking off a 6-part U.S. high-grade debt sale following earnings.
And this is to be expected, considering the fact that they're hiking the costs. Will debt investors like the fact that that spending will be going into not just more capacity, but higher prices because the commodity costs are increasing? Are people getting the bang for the buck?
So, Mike, you talked a lot about earnings. Let's talk about the P, the price, and the multiple. What's the multiple that these companies deserve now, given how different they are this morning to how they were 10 years ago?
Well, I mean, they're spending more money, to your point. So the multiple has come down. One of the calls we had this year, which I think kind of got lost in the shuffle, everybody was sort of saying, oh, I can't believe the stock market's only down 6 or 7%. This is ridiculous. The market's wrong. Well, first of all, the market's never wrong. Okay, you're wrong. Okay, and what was going on is that the PE multiple was down 18%. Okay, 18%.
A lot of compression.
I mean, think about that. 18% PE. That's as bad as last year going into Liberation Day. That's what we typically get in a recession, and earnings were growing 15% year over year. So we think the market, once again, fooled a lot of folks. It had its correction under the surface. It did a lot of good work, and that's why we got more aggressive towards the end of March, saying 18% is enough. I didn't expect us to rally like this, by the way. I'm not taking credit for that. But the entry point, I think, was pretty easy to kind of see back in late March.
Can we finish on energy?
Yeah.
We were mentioning that Chevron, Exxon, they've done nothing over the last 2 months. Since the end of February,
that's right,
pretty much flat. What's the story there, and what would you do with that sector at the moment?
Well, just change your start date. Since January 1st, I mean,
big first quarter.
They're up huge. And so, I mean, once again, equity market, is really smart. So the oil stocks started really working the day that we did the Venezuela extraction of Maduro, okay? And it was right, and oil services stocks. And they had a massive move, 30% relative outperformance. And they literally topped the day that, we attacked Iran. I mean, that was the day they topped on a relative basis. We wrote about that. So it's one of the reasons we got bullish on the market was we said, okay, market's telling us that oil prices are going to be lower in the future, right? The spread between Brent and WTI, we wrote about that. And then the relative underperformance of energy stocks. That's the leading indicator that tells, and I'm still confident about it. That's why if energy stocks started really outperforming, I'd get worried that maybe oil prices are going to be higher in the second half. So, look, I have an easy job. I just let the market tell me what's going to happen.
I feel like you're having a good year. You feel like you're in the groove?
Yeah, I feel I'm in the groove, exactly. Right. I feel like I'm in the groove. I'm sure that'll change again. It's kind of like a golf game,
Yeah, I was going to say, it feels like sports. When things are going well, you can see the ball just a little bit better, a little sharper.
You wake up and you just have that coordination, and then days when you wake up and you walk into a wall. I get it.
Financial markets feel like that sometimes.
I mean, it's true. It's sort of the days that things are lucid. The idea that the market is smart at sussing something out. I think it is telling, though, that oil stocks are down. And the idea here of what that tells you going forward. about how long this is going to last. When does that pivot, right? I mean, I guess that's the key question.
Mike, it's good to see you. It always is. Thank you, sir. Great calls recently. Mike Wilson there of Morgan Stanley. Let's give you an update on stories worldwide this morning with your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. The longest partial government shutdown in history is a step closer to coming to an end. The House has approved the first part of a two-part plan to reopen the Department of Homeland Security. Speaker Mike Johnson is now eyeing a separate bill that would finance the parts of the department outside ICE and Border Patrol through September 30th. Shares of Ford lower in pre-market trading. Ford CFO Sherry Xauusd telling Bloomberg's Romain Bostic that rising commodity costs will weigh on earnings.
The forward curves are still holding that this Middle East situation is going to be more on the short-lived side. You know, as a result, at this point in time, we are believing that there's going to be some recovery as we start to exit Q3, as we get through Q3 and Q4.
Ford also boosting its full-year profit outlook, driven by high demand for pickups and SUVs. Amazon is considering a reboot of The Apprentice with Donald Trump Jr. as the host. The Wall Street Journal reporting discussions are in the early stages, and Amazon has not yet approached the Trump family. If the show gets made, it would appear on Amazon's Prime Video service. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. That sounds super early, given that the family's not been approached.
No, but it sounds funny. Would you watch? I think I'd watch an episode.
I think obviously I'd tune in.
Yeah.
You know my taste in TV when I'm not at work. It's the kind of thing I'd probably tune in for.
It's currently happening at the Federal Reserve. I mean, it's still ongoing, so whatever.
Would you watch?
I think this is a marketing play for Amazon.
Bachelorette's
Good
not
job.
on at the moment on ABC.
Oh yeah, that's what I do. I
Also,
go home, watch
Trump
Bachelorette with the family.
Trump recently went down memory lane and truthed out his high ratings of The Apprentice. So I don't know. I think he would encourage Junior to do this.
Up next on the program, an insult to the Federal Reserve.
It's highly unusual what Chair Powell did. This is a violation of all Federal Reserve norms, and it is an insult to Kevin Warsh.
Up next, we'll catch up with the former Boston Fed President Eric Rosengren, live from New York City. You're watching Bloomberg TV.
Know how the market day started.
Find out.
Is the close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Overnight, things weren't looking great. You had crude pushing 120. You'd just seen the 10 and 30-year yield stateside close at the highs of the year. And the tech story was mixed. It was pretty mixed, with the likes of Meta getting slammed pretty hard. But since then, things have recovered somewhat. Equities are up by 0.4%. The Nasdaq's higher by 0.5%. In the commodity market, despite some, let's just say, not encouraging headlines coming from the Middle East, Brent is lower, not higher, down by 4%, following 8 consecutive days of gains for Brent crude. We're down to 113.58. And when you take that picture and plug it in and fold it over to what's happening right now In the bond market, yields are lower and not higher. They're down 5 or 6 basis points at the front end of the curve and down 3 looking further out on 10s.
I wonder if there's a regional bias. It seems like when trading is open in Asia and Europe, which is being much more significantly affected by some of the shortages, people feel a lot worse. And then when they come to the United States, based on all the guests that we've had, things are great. CapEx is booming. AI is going to save the world. And it feels like there's just such a different tone with the focus on earnings that people kind of look at all of the bright sides rather than everything else.
It's a pretty impressive stimulus program coming from 4 of the biggest companies on the planet, isn't it?
100%. You've got corporate stimulus instead of fiscal stimulus. So you've got both, frankly. So that's the reason why there's strength.
Yields down this morning, down 5 on 2s. The 2-year, 3.89. Under surveillance this morning, an insult to the Federal Reserve.
It's highly unusual what Chair Powell did. This is a violation of all Federal Reserve norms, and it is an insult to Kevin Warsh, Mickey Bowman, and Chris Waller to think that these other Republican nominees do not care about the institution of the Fed and that he alone can maintain the integrity of the Fed.
So here's the latest this morning. President Trump criticizing Jay Powell's decision to remain at the central bank after his term as chair ends, claiming he wants to stay, quote, because he can't get a job anywhere else. The former Boston Fed President Eric Rosengren writing, Powell views the legal actions against himself and others are intended to influence the vote on monetary policy. Eric joins us now for more. Eric, welcome to the programme. You, of course, sir, are entitled to your opinion. Do you believe this is an insult to other members of the Federal Reserve?
I do not. I think it is a reflection of the legal attacks on both the chair and one of the other governors. And as a result, it was intended to influence monetary policy, and he's standing up for the institution. So I think it's probably not what he wanted to do. My guess is he did want to retire. I'm sure his family would like to start seeing him again. He's been working very hard for 8 years, but I think he's doing it for the institution.
Eric, with that in mind, what kind of institution do you think Kevin Warsh is inheriting here?
I think from the new chair's perspective, it's a challenging environment.